represents an easing of financial conditions, and that is not what the Fed wants right now through the rest of this summer. For that reason, Costin and the team at Goldman think maybe range-bound has stuck around 4K for the time being. That's the story in the equity market after 6 straight weeks of losses for stocks on the S&P and the NASDAQ. The story of the bond market, we had 5 straight weeks of yields higher, and then last week happened, yields lower, down about 21 basis points on a 10-year. Right now, up about a basis point on the session to 292.76. I'll get to the Bank of America call a little bit later in the program. I want to turn to foreign exchange. On the dollar index, 6 straight weeks of gains on the dollar index, 6 straight weeks of dollar strength. That's been the story. And now the likes of HSBC, ING, RBC, Nomura, talking up the prospect, Tom, of euro-dollar parity.
Yeah,
Euro 1, dollar 1.
I'm glad you mentioned in developing markets, but over the weekend and into this Monday, John, to me, it's much more an EM story. I understand Turkish lira is idiosyncratic, to say the least, but there's just a giveaway here of a new level on EM, which is dollar strength, EM weakness.
China are part of the bigger story too, Tom, with what's happened through the FX market. The fact that we finally got some Chinese currency weakness off the back of the economic weakness, that's a change from, say, last year. We've talked about that repeatedly over the last few weeks.
On its way to 7 yuan would be the mystery there. And, of course, with yuan 6.79 is where we are on renminbi this morning. He is one of the great watchers of international economics. Carl Weinberg is chief economist at High Frequency Economics, but with real decades of work of when it unravels. Dr. Weinberg, thank you so much for joining this morning. As a general statement, with all of your experience back to the 90s in Ecuador and the rest of it, are we near a great unraveling?
Well, Tom, we're near a great shock. I don't know if we're going to unravel. You know, unraveling hinges on things breaking, and we're not in the business of predicting that things are going to break. That's a hard call. But we certainly are going into what Alan Greenspan used to call a rough patch for a lot of economies at the same time. We know about the pressure on consumers in the United States, all around North America, in Europe, in Asia, you know, so we see that happening. We see the shock out of China documented by the numbers overnight. And there's a pretty awesome decline in industrial production that we saw, a super awesome decline in consumer spending, and it's not over yet. We have at the same time the energy prices, which are behind some of the recession issues. And then we have central banks around the world hiking interest rates, which is probably the most reliable single indicator of an imminent economic recession of all of them. So it's room for a rough patch.
Carl, you have an exceptionally read and important China letter. How do you link China data in our conventional analysis with the absolutely original government in Beijing? Simply, will they blink or will they be forced to blink due to sub 3% GDP?
Well, that's a question we obviously have no historical precedent to turn back upon, but we know what the government is saying, and that is that zero tolerance for COVID is here to stay. That's the policy of the land. They're going to tough it out. So I don't see any sign of them breaking right now, and I can't point to any historical experience that suggests otherwise.
Carl, based on your data, what's the real on-the-ground trajectory for GDP in China right now?
Yeah, so we're looking at a contraction for the second quarter, almost certainly. You know, everybody looks at that year-over-year number of minus 2.5%, 2.9% on industrial production and says that's bad. But the reality of it is that normally seasonals would have industrial production falling by 11.5% in April from March, and we got a 19.5% actual month-over-month decline. So that means that seasonally adjusted industrial production was down 8% for the month. People who are familiar with converting monthly to quarterly calculus know that the first month of every quarter contains half of the volatility of the index for the entire quarter, which is to say we've already got a 50% of the information that we need to calculate the first quarter industrial production, and it's down pretty hard. It's down probably about, I'm looking for my exact number here, of 14%. For the quarter, and that's a really big hit. I don't see how GDP can grow with industrial production on that weaker trend.
Carl, a lot of people have been talking about this, and that really is one of the explanations for the weakness that we've seen in European assets more broadly, and frankly, the euro that John was just talking about, reaching parity with the dollar. Is there a part of the weakness in China that's not being adequately accounted for with respect to the U.S. economy, in addition to what's going on in Europe?
Sure, Lisa, you know this story. It's all about supply chains, all right? Industrial production could be down 1/1,000,000th of 1%, but if that 1/1,000,000th of 1% produces one part that I need for the Rivian, that Rivian needs for the car that they're making for me someday, then that Rivian's not going to be produced, and that's going to lead to an interruption of the supply. So it's not just the number, the percentage decline that matters, but it's the quality, it's the individual products that are seeing these decline.
Carl, but in all honesty, this is something that we've been talking about for a while. Is there any aspect of this that has not been accounted for right now based on the projections that we're getting for European and U.S. growth?
Well, I think when you look at what's happening to equity prices this morning, you're looking at the change in the mood on the bond market. People are now beginning to account for the decline in COVID seriously, all right, for the decline in China's COVID production seriously. And that's, I think, a new element to the thinking that this is real. It's not just happening right away. That's another thing that I think people have to start thinking about, that this drop in industrial production in China in April is going to affect the shipments that arrive here in May and June, because it takes time for things to move across the Pacific. So that means that we are not even beginning to feel, or just now beginning to feel, the impact of this slowdown in industrial production in China on our own supply chains. The worst is not behind us. The worst is yet to come on this side of the Pacific.
Carl, in that sense, I want you to take your international math and bring it over to the back end of the U.S. GDP equation. Jan Hatzius at Goldman Sachs has a stunning 1.6% U.S. real GDP for next year. How does diminished exports and massive U.S. imports fold into something like that statistic?
Yeah, so I mean, we've got a lot of things running against us right now in the GDP calculus, right? Number one, we all know about, as Lisa said, everybody's been talking about for a long time, the fact that energy prices have risen relative to all other prices, and that's a drag on consumer spending. So we know about that, right? We see on our balance of payments, we see that dragging growth down. So we know about that. And now we have increased uncertainty and higher interest rates making a drag on investment. It's hard to find an engine of growth amongst all of those numbers to push U.S. GDP back to the 2 to 3% numbers that we'd like to see sustained.
But are you calling for a recession? I don't hear that.
Right now, we are just bordering on calling for a recession, but we're consistently marking down our GDP growth numbers. We have to have a team meeting.
But Carl, come on, Carl, I don't mean to interrupt, but Carl, it's Monday. I need to make some news here. Give me a recession call.
I'll give you a recession call for Europe, guaranteed 100% for the second quarter. I'll give you a recession call for Japan, guaranteed in the numbers that we're going to see this week. For the U.S. economy is still a pretty powerful and large economy. We might be able to skirt a recession, but it's not going to be strong economic growth.
Carl, let me channel my inner John Farrow then. Does a slowdown in Europe lead us back to negative interest rates in Europe?
Well, you still have negative interest rates in Europe at the very short end of the yield curve. And the ECB is now just beginning to talk about changing that, about hiking interest rates. But even if they do 2 or 3 interest rate hikes, they're just going to get to zero. And they're not going to get to positive real interest rates for a very, very, very long time, possibly not even in this cycle.
Carl, wonderful to hear from you. As always, Carl Weinberg there of High Frequency Economics. Citi came out with their downgrade on China. The title of that note, Lisa, Lost Time is Never Found Again.
That's a really
very deep, wasn't it?
It's very deep, sort of like, you can't focus on hopes and dreams. You have to focus instead on
what's happening right now,
what's
the reality.
Happening, this sort of pain that's being suffered. Honestly, I think that is important for them to point out, that this basically isn't something that you can recoup. If people don't go to a restaurant, how do you get that back? We saw that here in the U.S. That's on steroids, so what's going on with China?
Did you see the Jeff Bezos complaint going into the weekend? The president put out a tweet. He said, you want to bring down inflation? Let's make sure the wealthiest corporations pay their fair share. So Jeff stepped up and defended this on Twitter and said the following, Tom. The newly created disinformation board should review this tweet. Then he went on to say, raising corporate taxes is fine to discuss. Taming inflation is critical to discuss. Mushing them together is just misdirection. I'm not sure Jeff Bezos is the greatest person to be leading the effort against corporate tax hikes, Tom, but the tweet itself from this White House, very, very confusing. Very
confusing is the right word, and I would defer to the political experts. Are they getting traction with this? And I really don't sense that, John.
They want to talk up inflation, Tom, as if it's a consequence of corporate greed, price gouging, the fact they don't pay their taxes. They're doing it again.
Yeah.
What they don't want us to talk about, that it's a failure of, say, public policy. But it's not just that. It's a whole range of things.
You know,
But going after the corporate greed angle, Tom, into the midterms, this is about politics and not policy, and that's when I get a little bit more concerned.
Here's the agony off of February 24, which is the day of the beginning of the war in Ukraine. Wheat up big. Rice up less so. This is U.S. wheat, U.S. rice. And John, for you this morning, because the Tots did so well, petrol. I said, what's petrol? Is that like a gallon of gas?
You can
John?
just call it gas, Tom.
Petrol. I didn't want to like natural gas. So
That was his gift to you,
petrol
John.
up
Are you rejecting
26%. Diesel up even more. I mean, John, these are real price increases, but they're not because of Jeff Bezos.
What do you do for birthdays? Is that a gift?
No, Tottenham got a gift with that handball at the end of it.
You're very happy with the result over the weekend, aren't you?
I was happy, but is that
Big
the
game
way?
for Arsenal
I
later.
still don't get soccer in that. I just.
What don't you get?
You win off a stupid penalty shot, which is sure you're going to make.
Sometimes that happens. Doesn't that happen in American football too?
Yeah.
I mean, are you trying to complain about the football rules in the UK when you've got baseball?
No, that's true. You're 100%
What on earth
correct
is that?
in that. Yeah, it is. It's like ridiculous.
It's, the American dream.
Yeah.
Hopes and dreams. It's not about hopes and dreams. Futures on the S&P, down about 0.25%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Germany plans to quit importing Russian oil by the end of the year. That's even if the European Union fails to agree on a ban in its next set of sanctions. German officials are confident they can solve logistical problems in the next few months. Russia's share of German oil consumption has declined to 12% from about 35% before the war in Ukraine. And Saudi Aramco posted its highest profits since its record stock market listing. It followed big oil rivals such as Shell and BP in reporting bumper earnings for the first quarter due to those surging oil prices. Last week, Aramco surpassed Apple to become the world's most valuable company. The U.S. Justice Department is investigating a mass killing in Buffalo as an act of racially motivated violent extremism. The shooting left 10 people dead and 3 wounded. 11 of the people shot were black. An 18-year-old white man was arrested. Law enforcement officials say he posted a hate-filled document online not long before the attack. British Prime Minister Boris Johnson is warning the European Union that changes must be made to the Northern Ireland Protocol. Johnson says the UK government will act on its own if the EU doesn't engage in genuine dialogue. Johnson visits Northern Ireland today. London is unhappy about parts of the agreement, which calls for checks on UK goods crossing the Irish Sea. And Bloomberg's learned that Carlyle Group is in advanced talks to buy government IT contractor Mantech International. The transaction values the company at about $4 billion and could be announced this week. Mantech primarily works with U.S. defense and intelligence agencies. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
There is very strong consensus for bringing Finland and Sweden into the alliance if they choose to formally apply.
If they decide to apply, this would be an historic moment. Their membership in NATO would increase our shared security.
That was Secretary Blinken and Jens Stoltenberg, the NATO Secretary General, talking on NATO membership going forward from here. Futures right now, negative a third of 1% on the S&P, on the Nasdaq 100, down about a half of 1%. Yields just a little bit higher by a basis point, 292.58 on a 10-year. Going into retail sales tomorrow, we'll touch on that a little bit more a little bit later. The latest news on Russia, Tom, in the last hour, McDonald's pulling out of Russia after more than 30 years. TK, you understand more than most the symbolism of doing that.
It is, and it goes back to The Economist and the price of a Big Mac worldwide, John. And the symbolism out of Russia there's important. As you mentioned, John, in the break, what took so long? And I really don't have an answer.
Maintaining their trademarks too, Tom. How do you think it's going to work out in Russia?
Don't know.
If someone,
we're making it up.
If someone did go after their trademark, I mean, who's standing up for it in Russia if that happens?
Don't know. We're making it up as we go. You wonder it'll be who after McDonald's. And, of course, we're on from February 24th. It gets a big long in a war that was supposed to be weeks. Well, that is not the case. Tina Fordham has been wonderful in briefing us on these international relations. It'll be one of our themes in Davos. We have Ian Bremmer scheduled to be with us as well, I believe, on our first day in Davos. Tina, thank you so much for joining us with Fordham Global Insight. Tina, I think Sweden and Finland are underplayed in the American press. I want to go there right now. Swedish independence goes back to 1523 and 1809. And as we speak in Estonia, across from Finland, there's 15,000 troops from 14 countries in Exercise Hedgehog, huge NATO exercises. What is the symbolism to Mr. Putin and to St. Petersburg of Finland and Sweden joining NATO?
Symbolism, I mean, it's well beyond symbolism. Of course, Finland has harsh and deep memories of its conflict with Russia. and the Finns were engaged in a terrible war in the 20th century. For this reason, the so-called Finlandization policy took place, with Finland also being ready for war with Russia, but not formally being part of NATO. Of course, their applications to join is another example of how Putin's so-called strategy in attempting to take Ukraine has backfired, and he's getting the opposite of what he wanted, which is a larger and better funded NATO.
How does he respond to this along an 800-mile border with Finland?
Well, you can see how the initial response is with threats, and the threats aren't working. I think the way that we should interpret what we're seeing from the Kremlin is a diminishing power. Putin made a big play to try to regain what he saw as Russia's imperial status, right? This isn't really about the Soviet Union. It's pre-Soviet Union, and it's failing. And his threats are being exposed as pretty hollow. Of course, he does have nuclear weapons and a chemical arsenal.
Tina, as the first chief global political analyst on Wall Street and as somebody who worked at Citi for nearly 2 decades, you work with clients, you're trying to understand and make them understand what is not adequately priced into the market. And while the Ukrainian situation is heartbreaking, it has sort of moved off of the front pages of Wall Street banks, of Wall Street investors, because they are looking beyond and seeing this as not being the biggest threat. Do you think that that's wrong?
Well, I do, because Wall Street's biggest concern is inflation and interest rate hikes. And this geopolitical turmoil feeds directly into both of those factors. Geopolitics is a driver in both of these risks to the market. Higher commodities prices, you mentioned food earlier, as well as oil and gas. So for Europe, yes, it's a security threat, much more directly, but for markets, this is the biggest geopolitical risk that becomes systemic that I've seen in my career.
Tina, do you think that the clients that you speak with fully understand this, or do they see this as one of those prolonged, entrenched conflicts that becomes sort of in the back of the rearview mirror, even though it still goes on?
I think it depends a lot on the person's personal experience and generation, right? There's a whole generation of people, say under 45, if they've grown up in the West, who have no experience with geopolitical risk, think it doesn't happen, therefore find it irrelevant. People on the older end of the curve remember the Middle Eastern conflicts and others, which did become systemic, right? Triggered a US recession. What I feel is happening is that people aren't properly connecting the dots between these. Ukraine's is exotic and far away. Gas prices in the United States are partially impacted by that, but even President Biden is blaming Amazon for inflation. That's bad economics and a misunderstanding of the interrelation between these factors.
Tina, we've been talking here about a holiday from history, a phrase used by former Secretary of Defense Robert Gates. Richard Haas has mentioned it as well, among others. As you say, we've got a younger generation learning about our history as we go. What is the key message of sustaining a short war? And as you know well, they always become longer wars.
There really aren't short wars unless we go back to the U.S., invasion of Grenada or something like this. Remember Churchill saying it'll be over by Christmas. It never is. I think that the notion that people will become less focused and less interested, that's got to be the case until we see another spike in escalation, which might not come along for a while. So for a lot of investors, this will be a watching brief. But as long as it remains unresolved and we have that, risk of escalate, even if it's to de-escalate, it's going to drive up prices and going to command attention again. And this isn't going to look like Afghanistan or Iraq, the conflicts that investors might remember.
Tina, a reality check from you, and thank you very much for that this morning. Tina Fordham at Fordham Global Foresight. TK, how many people believe this will be over by Christmas?
I don't know about over by Christmas, but there's always a trap here, John, of a short war. And I, just in the discussions I've had, I'm thunderstruck, John, by a lack of any collective memory across those younger. I don't blame them for that. It's been really something since 1989, or was it 1991? It's just been a very, very different setup, and we are back to things of our youth.
From an economic perspective, Lisa, the back end of the year, I think, is going to be the more critical one for the Europeans. When it gets cold, pretty simply, plain and simple, when it gets cold, the gas issues front and center.
When you start to see a doubling in price that people have to pay, that's going to bite, especially as you get also some of the supply chain disruptions still filtering into the economy. No one is talking about this ending quickly. The issue is just how much pain is going to be experienced on the economic side in Europe and then also in the United States.
June 9th for the ECB. What a meeting that's going to be. Good luck. You're not alone. So many people are saying just good luck.
Can we say it will not be a snooze fest? I think we can say
I think we could probably say that, Tom. But you never know. They try their hardest sometimes. Futures down. This is Bloomberg.
almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic. We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Damage is done. The pricing of the yield curve reflects a Fed
that is going to do a lot. How much of the financial sector is actually going to have problems as rates go up, as rollovers become more difficult?
Everyone's looking at this as, is it a cycle-ending bear market? I look at this more as a normal correction.
Our big issue is how little tightening is priced for next year.
The Fed is effectively trying to thread a needle wearing oven mitts blindfolded. It's going to be really tough.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Can we avoid a 7th straight week of losses? From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down about 1/3 of 1% on the S&P TK. Another big week ahead of us.
It is. It's a churning to a Monday, but I agree, John. The currency market's there, yields are a churn, and the equity markets just can't get a bid. And there's the drawdown, John, on radio. Standard & Poor's negative 16%, Dow lesser negative 12. Maybe that's expected. And the NASDAQ, and particularly, John, the non-profit-making NASDAQ, crushed.
Mike Wilson thinks we get crushed even more, Tom. He thinks that this could test 3,400 on the S&P. He says this is where both valuation and technical support lie.
I agree. Everybody's adjusting, and I'm not going to criticize them. It's extremely difficult to do the point of where you're going and the timing of where you're going, and a lot of adjustment over the weekend, John. I'm just going to say everybody's data dependent, including equity market strategists.
I'll say this. I think last week, Fed President Mary Daly gave the game up for some people, Lisa. I'm just going to repeat what she said again and again and again. I expect financial conditions to tighten even more. I would like to see continued tightening of financial conditions. What does that tell you?
Basically, they're not concerned by how much stocks have sold off. In fact, this is kind of what they welcome. This is what they're trying to gather in the market right now, which is a less optimal financing condition for people who want to get out there and get going, because that is opposite, antithetical to what they're trying to do, which is essentially slow demand. I do wonder, though, how much of the decline we've seen so far is because of tightening, expected Fed tightening, and how much more could come if people do agree that the growth scare is real.
Speaking of getting out there and doing things, data point of the morning out of China. In Shanghai, they did not sell a single car last month. What a story developing there, Lisa, over the last few months.
Why buy a car if you're not allowed to leave your house?
Precisely.
And right now you're seeing the ramifications of that in economic data that was tremendously worse than people had expected, and that is on the official level. Now we wait for China to respond with policy measures.
Well, base case right now, Chinese growth for a lot of people has come down from 5.5, 5, down towards 4. City this morning, that title again, Tom, lost time is never found again. They're looking for something in the low 4s, 4.1% on GDP.
I'm in the camp. I had a talk with Richard Haas at length last week. John, thank you, Ambassador Haas, for that. And John, it's real simple. Elizabeth economy owns a high ground here, and this is a leadership in Beijing that has to react. I don't think we're calculating in here the pressures they face as they go to that party Congress this fall.
Well, Tom, build on that. So City go from 5.1 to 4.2. Some people think we go 4.14, maybe even 3.9. I think that you had Nomura out in the last few weeks looking for the high 3s. What do they need to do? What can they do?
They're going to have to get on China. They're going to have to figure out a COVID policy that dovetails with a China that's working. What they're doing now is not working. There's no question about that, and they're going to fix that. And are you optimistic that there will be a lockdown amendment or an end to the lockdown? I would say, John, in every interview we've had, it just comes down to China and vaccination.
We'll see. We'll see. Futures right now down 1/3 of 1% on the S&P. On the NASDAQ, we look a little something like this, down 1/2 of 1% on the NASDAQ 100. Looking at yields higher for 5 straight weeks. Then last week, yields lower on a 10-year again this morning by about a basis point to 291.12. And Lisa, euro dollar, how many calls have you seen for parity? Euro dollar right now, 104.33.
Right. What's going to make it break to parity? And could there be some resilience if the ECB does decide to hike rates? Is there resilience if they don't decide to hike rates? What do they do? This is the big question mark. In the U.S., this is countdown to retail sales tomorrow. Today, the economic data point of the morning is going to be at 8:30 a.m. Empire manufacturing data coming out, the latest read on what happened in May with respect to manufacturing, with respect to deliveries, and more importantly, demand, especially in light of the University of Michigan Consumer Sentiment Survey that came out on Friday at the lowest level going back to 2011, really decelerating much more than previously expected. At 8:55 a.m., New York Fed President John Williams is planning to speak at the Mortgage Bankers Association event in New York. I want to understand his view on housing, especially as mortgage rates rise to the highest levels going back to 2009. At what point does this start to really make a hole in the housing market? And at 9:45 a.m., there's a news conference after a meeting of EU and U.S. officials, the Trade and Technology Council, talking about supply chain issues. How do they deal with Russia and the invasion of Ukraine and some of the oil prices in particular? Among those joining U.S. Commerce Secretary Gina Raimondo, Valdis Dombrovskis, and Margaret Vestager, both of the European Commissioner. How much do they come out, John, not only having to do, I was saying this before, with Russia and Ukraine, but really China, because that seems to be the elephant in the room when it comes to supply chains.
Front and center, particularly after that data we had coming into this morning. Just brutal, ugly. Lisa, thank you. Evan Brown, head of multi-asset strategy at UBS Asset Management, joins us now. Evan, you've got a strong dollar call in the mix, but I want to start with this. It's just a framework for the way you're thinking about this market. From peak inflation to higher trend inflation. Evan, how important is that change?
Yeah, it's important because it creates, I think, more uncertainty, actually, because we've seen these persistent surprises in inflation. We've seen the Fed and other central banks have to continue to ratchet up their tightening. But now we've got this interesting dynamic where, okay, you're starting to see inflation peak, but where are we going to level out at? And that's the big question, I think, over the coming months and really the second half of the year, right? We actually saw core PCE, well, what's forecasted for core PCE after the CPI and PPI prints come down a little bit or below expectations, 0.2%. We're so data dependent right now. Is that just one print? Is that a change in trend? And so the potential economic outcomes from here and therefore for markets are really, really uncertain. And that means continued interest rate volatility.
Is growth dead?
No, I don't think so. Growth stocks will, well, are you talking economic growth or
No, I'm talking growth stocks. I'm talking to you.
If you were talking economic growth, TK, that would be thoroughly depressing, wouldn't it?
That was like a Luke Kawa answer. That was like I expect that kind of answer from Luke Kawa. Lose the snark, Evan. Growth stocks. Is Apple dead?
No, definitely not. Definitely not. I mean, we've seen a significant derating of growth stocks, obviously, disproportionately where it should be happening, which is in profitless tech. And we're seeing kind of the crash that you expect when you wring out the excess and people have thrown all this money into that space and you just don't have the future earnings power. It's all speculation. But you talk about something like Apple. I mean, this is a company that has persistently been able to put up earnings and will consistently be able to do that in the future. So some valuation compression, yes. Maybe some earnings coming off, yes. But growth stocks are far from dead.
Evan, how much are you whipping out the stagflation playbook at this point, even after being really optimistic, particularly earlier in the year, on the prospect for stocks to keep outperforming?
Yeah, earlier in the year, we were quite optimistic, and then we had these series of shocks. I think that stagflation, it's early in the U.S. to talk about stagflation. I mean, we're still in a pretty good economic environment. Yes, policymakers are trying to slow growth, and hopefully they thread that needle. But you know, Europe and what Europe's dealing with the Ukraine war, what China dealing with COVID, you know, these are stagflationary shocks, no question. You are seeing stagflation in places like the UK, and so that's something market-wise that we have to hedge against. And as everyone knows, commodities is a decent place to hedge in that area. It is a tough environment, though, for your typical stock bond portfolio. No question about that.
Evan, in the mix, front and center. Let's finish here. Your strongest conviction view is in foreign exchange. It's on the dollar. Can you give us an idea of where you think this is heading? We're at 104.33 on euro dollar. Where's this going?
I think it's at least parity on euro dollar, and I think it's at least 7 on dollar CNH, because, like I said, those growth risks are much more a feature of the ex-US growth environment. You have Europe and China, they're not making decisions, policymakers are not making decisions purely economically driven. And, you know, it's brave, it's commendable that Europe is moving in the direction of an oil embargo and perhaps a natural gas embargo later this year. But that is a very risky strategy, right? That is a big concern on economic growth. China, it's not just economics, right? It's cultural. They're trying to protect their elderly population, and pursuing with this zero COVID policy And finally, you've got solid U.S. economic growth, but you also, as you mentioned earlier, have people like Mary Daly, a dove on the FOMC, saying we need to continue to raise rates and tighten financial conditions further. All of that plays into further dollar strength from here.
Evan, great to catch up, buddy. As always, send our best to Luke. Evan Brown there of UBS Asset Management. Euro-dollar parity, Tom, for the team over at UBS, with Evan and Luke leading the way. Dollar CNH at 7.
Yeah, I would say that over the weekend we began to finally see that. You know, folks, this path from 104, 103, 210 is a big thing for Wall Street firms, for global firms and city firms, I should say. It's not it's un-American, John, but there's just something about parity which I think people really run from. It's a tougher decision than saying we're going to go to 105 or something.
Yeah, this time I'd suggest that the Europeans don't want it there, and before maybe the ECB was okay with it. Euro-dollar at 104, I'd say, is problematic already.
John, this is one of the great signs of a slowdown, and you're going to have to translate this. This is the Minister for Safeguarding. It's all over the British news. Thank you, Sky News, for it, but everybody's got it within the UK news. And this is someone with a very serious job, modern slavery and all sorts of social issues. And Minister McLean, John, says in London, take on more hours and get a better paid job.
Yeah.
This shows up like clockwork in a slowdown.
I don't know what to say, Tom.
I'm just speechless.
I'm a loss for words. Just at how detached policymakers are sometimes from reality is just unreal.
It's like a Swiss watch, John. It happens
every single time.
slowdown.
I agree. It's the one thing politicians can guarantee you, that they'll say stupid things. Futures on the S&P down 0.25%. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. It's another dramatic change in Europe's security structure triggered by Russia's invasion of Ukraine. NATO members rallied around Finland and Sweden after they announced plans to join the alliance. The one NATO member to voice concerns was Turkey. The country is unhappy that Sweden and Finland have had relations with Kurdish militants active in eastern Turkey. China's economy is paying the price for the government's COVID-0 policy. 2 key gauges of economic activity have fallen to the worst level since the start of the pandemic. Industrial output unexpectedly fell 2.9% in April, whilst consumer spending shrank 11.1%. Economists at Goldman Sachs have cut their forecast for U.S. growth this year and next. The new outlook reflects the shakeout in financial markets and higher interest rates. Goldman sees the U.S. economy growing 2.4% this year and 1.6% in 2023. And McDonald's is leaving Russia after more than 3 decades operating there. The fast food chain will sell its Russian business and take a write-off of up to $1.4 billion. McDonald's said that in the wake of the war in Ukraine, continued ownership of the business in Russia is not consistent with the company's values. And JetBlue has begun a roughly $3.3 billion hostile takeover attempt of Spirit Airlines. It launched an all-cash tender offer and is urging Spirit shareholders to vote no on the airline's takeover by Frontier Airlines. The JetBlue offer is $30 a share, $3 less than its initial bid. JetBlue says it would pay the higher price if Spirit agrees to a, quote, consensual transaction. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Companies know they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Tuesday, Bloomberg is live from the Greater Boston Chamber of Commerce annual meeting, exploring the challenges and opportunities in New England. Among our guests, Arjuna Capital Managing Partner Natasha Lamb and DraftKings CEO Jason Robbins. Special coverage live from Boston begins Tuesday at 2 p.m. Bloomberg, business, technology, and innovation uncovered.
This is really the moment for Europe to take itself to the next level, to launch the reform, to grant Ukraine, to legally anchor Ukraine in the EU integration project by granting the candidacy status.
Dmytro Kuleba there, sitting down with Maria Tadeo, the Ukrainian foreign minister from New York City this morning. Good morning. Futures negative 1/3%, called it a quarter on the S&P. On the Nasdaq 100, down 0.4%. Yield essentially unchanged on a 10-year, 291.67. My favorite story of the morning, Tom, Goldman Sachs. Do you remember the junior analyst that complained more than a year ago about working conditions? Yep. So Goldman made a call to give partners and managing directors unlimited time off. That was I just love the way this is going to work out. On a serious note, they get the unlimited time off. What I think is good about this, you don't go with a maximum. You don't even go with unlimited. You have to go with a minimum if you want people to take time off, Tom. So the new minimum at Goldman is 15 days. The firm expects them to take 15 days off.
There'll be lots of giggles on this, but John, I have lived this. And it's an addiction, and it's not funny. I will make it clear. It is a really serious
Couldn't agree more.
issue. And as Matt Miller brilliantly said in the 5 o'clock hour, this is about the United States of America. And it goes back to the construction of the work ethic. I'm going to put it about 1820 or 1830, ex-Benjamin Franklin, where they codified Franklin from a generation earlier, and it's a unique American disease.
It's counterproductive in a lot of ways, Tom. Think on the regulatory side, you know, the 2 consecutive weeks that you're meant to take. If that could be carried out through the whole business sometimes, Tom, I think that would be super effective too.
I think it's easily solvable. I don't know why it's solvable. I don't know the details of what
Are you admitting now, after having a go at us in Europe for a long time, are you admitting that they should go the European way? Is that your suggestion?
No, I'm not saying that. I'm saying it is unique American construction. And the bottom line is at gunpoint, you say to people, you're taking off X days of what you're doing. We're going to shut down your phones, shut down your security, shut down your computers. Everybody somebody grow up and just do it?
That's the way forward, Tom. You're sounding European, I've got to say.
I don't do holidays. You know, what's a holiday?
Isn't true.
2 weeks?
That is not true.
2 weeks?
You do holidays. 2 weeks should be. I think 2 week consecutive should be forced on everybody.
Oh, man,
if you get paid leave, without a doubt. Without a doubt.
Anne-Marie Horton's in Abu Dhabi with no sleep. And right now, Maria Tadeo in Brussels with us off of her important interview with the Ukraine foreign minister. Maria, what did we learn in that interview? What was the distinction that mattered?
Well, I think there's two things that he made very clear. One is that, of course, they're disappointed by the fact that they didn't get the treatment that Sweden and Finland get when it comes to NATO. And their best hope is, of course, joining the European Union. And then the other takeaway for me is that the peace talks with Russia, they're completely over. I mean, they're toast. We knew they weren't on the phone. They hadn't been for weeks. But now if you listened to those words of Dmytro Kuleba, he made it clear we don't want a peace deal or any type of ceasefire. What we want to get is a big victory. It's a big win that makes it clear to Russia, don't try it again.
Meanwhile, we did have this idea of Finland and Sweden joining NATO. Turkey initially was opposed to it, but has basically cleared the way at this point. Maria, how significant is this, and what are you looking for in terms of a response from Putin?
Look, this is a huge watershed moment for both Finland and Sweden. I think this is something that if any of us had been asked to guess, would these two countries ever join NATO? 2 months ago, it would have been a flat out no. I mean, this is a huge U-turn in their foreign policy. When it comes to Russia, of course, we've heard already that they say this is a security threat, that they are prepared to act. But a lot of European officials that I speak with are actually very skeptical about this because they see the mess in Ukraine and the Finnish army. You know, this is very well prepared and they're very NATO compatible, by the way. Everything that they use, the weapons, the training and so on, they're ready to go. And in fact, the expectation is that by the end of June in that Madrid summit, this is going to get cleared. I know that Erdogan has suggested perhaps there's a veto, that he's unhappy about Sweden, but a lot of this is seen as a way to get concessions from the United States. But overall, everyone that I ask tells me by the end of June, this is a done deal. They're joining.
Anne-Marie, we've seen OPEC meeting after OPEC meeting over the last few months last from anywhere to 10 to 15 minutes. We've seen a few of them last 13 minutes. What is the relationship between this administration, their partners in the Gulf, at the moment we can even call them that, and what they're going to do about the energy situation around this world?
Well, today, Jonathan, the United States is trying to show a massive show of strength to this relationship and really try to fortify it. Have you seen the list of high-level officials who are making their way over to Abu Dhabi to pay their respects to Mohammed bin Zayed, who is now the leader of this country after the death of his late half-brother? We have Vice President leading this delegation. I'm already here on the ground with Antony Blinken, who was at those NATO foreign ministers meeting in Berlin. And then on top of that, we have the Secretary of Defense, the CIA's Bill Burns, climate envoy John Kerry. The list goes on. This is clearly, and what a U.S. official said to me about strengthening that relationship. But it comes, Jonathan, and you insinuated that, at a fictitious time for the administration and partners in the Gulf. The Gulf has security issues, especially after Saudi Arabia and UAE were attacked by Iranian-backed Houthi missiles. They do not want Washington re-entering an Iranian nuclear deal. At the same time, the U.S. is asking for something, and that's the pumping of more oil. And so far, the Kingdom and the UAE, which both have the biggest spare capacity out of the entire OPEC group, are snubbing them.
Anne-Marie wanted to make it very clear, Tom, that she is not on vacation, just to be very clear.
Oh, no, it's a working trip.
It looks like vacation.
She is not on vacation.
It looks like vacation, but it's not.
It looks like it. It sounds like it, Tom, but it's not.
You know, I mean, there's 14 hotels in Abu Dhabi with helipads. I guess that's what you call them, where the helicopter lands on the hotel. And John, it's just very simple. You can watch a sunset soiree there.
You could, Tom.
I could give you a quick glance of the ocean. I could give you a quick glance at the ocean.
Let's do that on this not vacation trip.
This is where some of my other colleagues are, but yes.
Oh, nice zoom
out there. That looks terrible.
Oh,
that's not a vacation. There's the beach, Tom.
It's good. Everything's got an umbrella.
I have yet to go to the beach yet, though. So I've been riding on the terminal, and I'm joining you.
All I can say, John and Tom, is that basically the Maria and Anne-Marie segments are turning into why aren't we able to go to any of the places that they go, literally every time.
Honestly, do you know how many times these two have called me up and complained?
No, but Maria,
if I hear any more complaints,
Maria, very quickly here, Maria, what's the mood in Helsinki?
What's the mood in Helsinki about NATO?
Yeah.
Look, I think they're very calm, and they've been preparing this for a while now. And you know, this is an army that they feel knows how to fight, and it's NATO compatible, ready to go. I don't think they feel scared.
I don't care. I'm just trying to get a road trip to Helsinki going for team surveillance. We'll meet you there.
I was there yesterday, Tom.
It's not a vacation. Anne-Marie, thank you.
Helsinki.
AMH in Abu Dhabi, not on vacation with
there's no night, John.
Tadeo,
John, the sun
who's
never...
not come back from vacation either.
It's
unlimited. The sun doesn't go down in Helsinki.
Futures down 1/3% from New York. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Bramo talked to me in the commercial break about crashing markets. It's exactly the same as it is when we're on air. Don't worry, you've not missed a thing. Futures down 1/3% on the S&P, I'm sure it was. The Nasdaq down about 0.5%. 6 straight weeks of losses on the S&P, wondering if we're going to make it 7 or not. It has been absolutely brutal out there. Keep going back to the work of David Kostin over at Goldman on the equity market, a downgrade from him for year end. But the 3-month price target essentially is where we are at 4K, because this Fed has told us they want tighter financial conditions. Essentially, this Fed has told us that it does not want equities up, spreads tighter, and a weaker dollar and all of the above. So do you really want to push against that as we work our way through the summer and this Fed looks to hike again at 50 and again at 50 and maybe, who knows, again? So let's talk about that. That's the change in the bond market we need to get our hands around. This is something that UBS said to us just moments ago. Evan talked about a trend inflation story that's shifting. So you go from peak inflation to higher trend inflation. What does that mean for this Fed, for this FX market? What does it mean for the 2-year? Let's talk about the 2-year. Mark Cabana of B of A is going to catch up with me a little bit later this morning. They are at 350 year end on a 2-year. Right now on a 2-year, 258. And some people think we've already seen the peak. Bank of America do not think that. They think this Fed has got to push forward through the summer. And when we reassess later this summer, they're going to be reassessing in a way that drives yields higher at the front end, not lower. So let's get to the FX call, euro dollar. Take a look at euro dollar right now. Where are we? 104.26. We took out the closing low of late 2016 last week. We came very, very close to taking out the intraday low of early 2017, which is about 103.41, Tom. Came really close to that level on Friday. But this is the call that's coming through again and again and again by a lot of people, euro-dollar parity. Now, I know you've seen this movie before. You know the ending, we don't make it, we bounce, we rip, whatever. It's different for some people this time around, Tom. Yeah. This ECB is really, really struggling. Whether they like this weakness in the euro or not, what on earth can they do about it?
David Fogel's way out front on this at Deutsche Bank. And, John, it's real simple. Euro came calculated at 1.16, and we get ever farther away from the math of decades ago. Parity, is it like Dow 10,000? No, John, it's not like Dow 10,000, but it's an emotional statistic. It's the difference between 101 and 1.00 is a big deal for them.
I would say, Tom, if they make it, Lisa, no one's putting a baseball cap on with euro-dollar parity and celebrating. That's not a good thing.
No, and honestly, we heard from certain ECB officials coming out and saying that they are concerned about the weakness in the euro and that it could potentially become a problem, a price stability problem due to importing inflation. This is a new regime for them.
June 9th, the ECB meeting. Looking forward to it, kind of. Your cross-asset price and price action looks like, I can't even keep a straight face as I say that. I'm really looking forward to it. Let's get you some single names, some movers. Here's Romain. Morning, Romain.
Hey, good morning, John. Of course, we continue here in the U.S. equity market, a sentiment-driven market here. Keep an eye on Apple shares, probably one of the biggest barometers for risk sentiment out there. And it's been pretty weak, coming off what is 7 straight weekly losses right now, despite that rally that we saw on Friday. Shares slightly lower here in the pre-market, down about 0.6%. And that's really the story for a lot of these big cap tech names here. Not really seeing a whole lot of bids come in. One of the outliers here is Netflix. Those shares up about 2%. And this is really on the back of an upgrade over at Wedbush, taking this to a buy equivalent rating. A lot of concerns right now by Michael Patrick that this will be a quote-unquote slow growth company, but in his words, it will be immensely profitable, citing some of the new moves that the company has been putting on the table, including staggering some of its more popular program and potentially creating a new ad tier. And then keep an eye on McDonald's. Shares only down about 0.5% right now here, but the end of an era there after 32 years in Russia. The company now basically going to quote-unquote de-arch its business in Russia, basically selling off all of its businesses there in Russia. And not only, of course, symbolic for McDonald's, but really kind of that embrace of Western-style capitalism that we see in Russia, at least for right now. It appears that era is over. Flip up the board, a lot of deals going on out there today, including that JetBlue hostile bid now for Spirit Airlines. Now, this is now going to be about a $3.3 billion bid. That's lower than the $3.6 billion bid that JetBlue had on the table. They said they're willing to go back to 3.6 if Spirit is willing to, I guess, come into this consensually. But remember, Spirit still has that $2.9 billion deal with Frontier, which it still says it's their best offer. Nevertheless, Spirit Airlines up almost 18% here on the day. JetBlue slightly weaker. And of course, Twitter shares bouncing all over. Keep an eye on 39.31. That's a key level here. That was the April 1st close of Twitter, the day before, or right before Elon Musk disclosed that 9.2% passive stake. Remember, this stock rallied above $50, never to that 54.20 level, but now it's going to retrace all of the gains it had made since Musk closed that stake. Those shares down about 2% right now, Tom, in the pre-market.
Romain, thanks so much. Greatly appreciate it. The close, look for that this afternoon as well. Long ago and far far away before the advent of financial media, there was actually an understanding that bonds were not just full faith and credit, or FF&C. The financial media only quotes full faith and credit. Thank you, Lisa Abramowitz, who's made a career of looking at credit and high yield. So too, Amanda Lynham, joining us, global credit strategist at Goldman Sachs right now. In the old days, you had a blue book, a Standard & Poor's blue book, and you thumbed through it and you looked at corporate bonds. And as say Dan Fuss, the giant at Loomis Sales, has said, you can enjoy losing money at corporate bonds. How much are we losing right now with the aggregate index down 10% plus?
Good morning, Tom. Thanks for having me. So a couple of weeks ago, we talked about how both IG and high yield total returns were off to their worst start on record. So it's been a very, very painful year. I think the key risk for bond investors, in our view, is that that's been entirely driven almost by the rates component, and spreads have held in very well. So in the event that we do get a recession, which is not our economist base case, but if we did get one, there's a lot more room for spreads to widen and kind of even exacerbate those losses that we've already recorded year to date. And so that is one of the key risks to the market.
What are IG, investment grade, old style bonds? I want to buy a General Motors bond. It's a part of the aggregate index. What do you do where equity people say, I'm going to go to cash? Or, you know, I think there's a dialogue about what equity people do. What do bond people do when they, quote unquote, want to go to cash?
Yeah, they often move up in quality or shorten duration, but one of the risks that we've highlighted in our recent research is that actually moving too far up the quality spectrum in IG also has its risks, because those are the companies that are likely to move ahead with, say, debt-funded M&A or aggressive shareholder returns, irrespective of the slowing economy. And so we actually like within IG that sweet spot of BBB rated firms. Those are companies that we believe are committed to staying investment grade, but are likely going to behave in a more conservative fashion relative to, say, their highly rated peers, cash-rich pharma and tech companies, for example, that will do M&A regardless of the backdrop.
Amanda, where are we in terms of what we're pricing into the credit market right now? Initially, you talk about the worst start of the year ever. That was largely due to rates. That was not due to the extra cushion of yield that accounts for potential defaults. Now we're shifting into something else where you're starting to see that widen out. How far in that process are we?
That's right. So we have not priced in a lot of default risk, and specifically kind of zooming in on the high yield market. And we do think that that's probably appropriate at this stage. So just to set the backdrop, our economists are not expecting a recession as their base case this year. And what we've said is that even if we do have a downturn and growth slows substantially, the high yield market is unlikely to experience the uptick in defaults that we're kind of used to seeing in previous cycles. There are a few reasons for that. One is just we didn't have a default cycle that long ago, right? So in 2020, we had a lot of the weaker firms cleaned out of the high yield market. Energy and metals and mining and kind of natural resources are also in a much better position now relative to previous cycles. And those are historically the vulnerable sectors. And then also we have a lot of cash on hand and balance sheets are very strong. So to answer your question specifically, we're not baking in a lot of default risk in the high yield market right now based on current spreads of 450. But that's probably not inappropriate given the I would say the higher quality and the increased strength of the high yield market moving
Amanda,
forward.
a lot of people would agree with you, and we see this note after note. Basically, even if we get a recession, things don't have to get that bad in credit because people have pushed out their maturities so far and because there was this washout. What does that mean in terms of how high the Fed can go with the Fed funds rate before we have a real problem in credit, which is really the market that the Fed watches and potentially would respond to, not equities having a bad day?
Right, exactly. So our economists expect a terminal value of 3 to 3.25%. A large amount of that is already reflected in Fed funds futures, for example, and baked into the market. I think there's a lot of room to go for financial conditions to tighten and really for the Fed to deliver on the hikes that are already priced in to the market. And I think credit investors are expecting that. Really, the key risk for credit is if we had a freezing up of the primary market activity such that corporates if they wanted to access the debt markets, could not. Right now, we're actually saying that a lot of the muted supply volumes are due to an unwillingness to access the market on the side of corporates, as opposed to an inability. And it goes back to exactly what you mentioned. Corporates have the luxury of being patient. They spent most of 2020 and 2021 raising cash, pre-funding years in advance, and so they're not really at the whim of the market in terms of having to execute in a choppy conditions. I know Jonathan talked about this on Friday afternoon on his program, but really on those windows of stability, you're seeing a lot of activity, and we think that's indicative of a market that's still remaining open, but yet much more challenging in terms of timing that appropriately.
You have no idea how jealous TK will be. Tom's going to be so jealous that Real Yield got the plug there. Amanda, thank you.
I mean, why would I expect anything else?
Amanda Lanham at Goldman Sachs, a good friend of the show, Tom.
Well, the show has a PR staff of 4 people. What do you want?
Good show.
John, let me tell you the real world here. You got your blue book, your Standard & Poor's book. Pim Fox used to have one on his desk. I got a GM piece, 10 years out. It came in January. I'm enjoying a 15% decline in price, annualized 39% decline. For retail, that's the real world of IG right now.
Coming up, Mark Esper, the former U.S. Secretary of Defense. I'm just reading the tease, Tom. Okay. That's what I'm trying to do.
Okay.
Are we going? Then we've got to go. Don't really have much choice.
Let's talk about our feelings.
Very upset about that, aren't you, Tom?
The real yield.
Gonna have to get over it. Futures down 1/3% on the S&P. From New York, for our audience worldwide, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Twitter is now on course to wipe out all of the gains the stock's made since Elon Musk disclosed his stake in the company. Shares are lower in pre-market trading today. On Friday, Musk tweeted that the deal is on hold, but that he's still committed to buying. Germany plans to quit importing Russian oil by the end of the year. That's even if the European Union fails to agree on a ban in its next set of sanctions. German officials are confident they can solve logistical problems in the next few months. Russia's share of German oil consumption has declined to 12% from about 35% before the war in Ukraine. Ryanair has issued a guardedly optimistic outlook for the vital summer season. Europe's largest discount airline says that a strong bookings trend could still be disrupted by a number of factors, but a recession isn't a major concern.
In every past recession, we've grown stronger and faster because people don't stop flying in a recession. They get more price sensitive. IKEA, Lidl, Ryanair will be the beneficiaries of a downturn, and I would look forward with some optimism to an economic downturn because I think it would be better for Ryanair's business. We'll keep passing on incredible value to families in Europe for the next 12 months.
Ryanair says it is expecting what it calls reasonable profitability this year. The U.S. Justice Department is investigating a mass killing in Buffalo as an act of racially motivated violent extremism. The shooting left 10 people dead and 3 wounded. 11 of the people shot were black. An 18-year-old white man was arrested. Law enforcement officials say he posted a hate-filled document online not long before the attack. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Other companies, I think, are going through situations that are going to be long-lived. And I put Apple in China, the never-ending COVID lockdowns, what that does for an important end market, what that does for never-ending supply disruptions. I put them in that camp.
Great to hear from Barton Crockett there, the senior research analyst at Rosenblatt Securities. With Tom Keene, Lisa Brabbett and Jonathan Ferro, this is Bloomberg Surveillance, with equity futures down 1/3% on the S&P. On the NASDAQ 100, down about 1/2%. Yields unchanged, TK, your 10-year, 291.85.
Very good. Right now, let's jump to, over the weekend, food. You know the food on your menu. You know the food at the grocery store when you check out. Aisle 7 is particularly expensive. That is meat, poultry, produce, and the rest of it. Kriti Gupta here with the core of it all for the world. Not rice, but next thing to it, wheat. Kriti?
Crucial for the breadbasket of the world, Tom, and this is really where you're seeing a lot of pain when it comes to that food inflation. We have to talk about, though, the news over the weekend. As you pointed out, India now creating an export ban, essentially saying that that extra capacity that they had to create some of that wheat, well, they're not actually going to look to export it. They're going to try to address the food shortages right here at home, which brings me to my chart of the day. We're looking at wheat futures that is actually digesting that price action. You see them now going back and testing the levels you saw in mid-March coming off of the war in Ukraine. And remember, Ukraine and Russia together make up over 25% of the world's grain supply. So when you see this kind of issue with India, which, by the way, isn't even one of the biggest wheat exporters in the world, it brings to the question, or to the spotlight, essentially, how many other countries are going to follow the same pattern and not export in order to really talk about their domestic interests.
Kriti, thank you so much. This will be a theme for us through the week here. And front and center, the UN Food Index is basically a moonshot at this time. And Curran knows that China is not a moonshot. It is in lockdown, and the numbers are grim. He is our chief Asia economics correspondent. And how surprising were the numbers today?
I think revealed, Tom, that things are even worse than people were expecting. It shows how deep the lockdowns and the restrictions are impacting the economy. A couple of takeaways for me was the big drop in retail sales, down 11%. I mean, that cuts to the core of consumer confidence. We saw the surveyed jobless rate go up to 6.1%. But within that, in fact, youth employment, 16 to 24-year-olds, that hit a record rate of unemployment. Now, that goes, of course, to the core of the whole government party mission to begin with. So I think definitely showing the fierce impact of the aggressive COVID-0 strategy. There is a view that perhaps this is the bottom, the trough, because Shanghai is nudging towards a reopening. It's a long way to go, of course. But even allowing for that, the question is, how long will it take for the recovery from here? And it does feel like a long road back.
And a lot of people are also looking to policymakers in China for some sort of fiscal easing, some sort of more further stimulus in order to reignite the economy. Can Chinese authorities really do anything to really fill in this pain that is very widespread at a time when people still are not moving around at the pace that they were before?
Well, exactly. So some people are calling it a kind of a spinning in the wheels type traction, Lisa. So, you know, the idea is you can't have both COVID-0 and be stimulating your economy at the same time. The authorities, of course, are talking about spending money on infrastructure. The central bank is taking some steps to get money into the economy. But, of course, all of that's being offset by what's going on with COVID-0 and the aggressive lockdown. So really, it's not about stimulus in China. It's more about just putting a floor under the amount of pressure that the economy is under now. It should be said, we did have one material development over the weekend. The central bank came out and brought down mortgage rates for first-time home buyers right across the country. And that's important because it went beyond money market steps. It's an actual real economy measure, and it demonstrates that A, it's nationwide, and B, policymakers are going beyond sort of more minutiae measures, and they are now starting to take some broader base measures. So it does indicate that the officials are certainly concerned about where the economy is headed.
And this is a delicate question, since I know that public sentiment is a somewhat difficult thing to gauge and somewhat sensitive to talk about. How much has Xi Jinping lost support as people struggle through lockdowns, have to stay in their homes, can't get enough vegetables or food just more broadly because of the lack of transportation and personnel? How much has he lost?
Well, obviously difficult to answer that on a kind of a scientific basis, at least, in terms of it is in the world of opinion polls and the like. But, anecdotally, in terms of open source social media, for example, it's been well reported by our colleagues and others that there's a lot of discontent on the ground, especially in Shanghai, which has been taking the brunt of this lockdown for so long now. It's certainly the foreign chambers of commerce in China, they are raising their voice saying, look, this is unsustainable. There needs to be kind of a middle ground here. And there was today, in fact, in the Chinese press, there was a 6-month-old essay published by Xi Jinping, basically underscoring that, look, the economy has to be looked after. They need to make sure that there isn't mass unemployment, etc. All that said, though, there's no hint of a political pivot from the very top. I mean, all the public messaging from the standing committee down has been that COVID-0 is the way forward. They do not want a public health crisis on their hands ahead of the Congress later this year. So for now, it's a question of how can they manage both? How can they manage COVID-0 and how can they manage to keep the economy ticking over?
And you have chastised me that I've gone deep into China, 1,200 feet from the harbor in Hong Kong. If I go 1,200 miles now, say from Shanghai to Chengdu, what is the lockdown like in the rest of China that we don't talk about?
Again, obviously Shanghai gets all the headlines because it is the big financial capital. It is the kind of New York of Shanghai. But you are right, Tom. Right around the rest of China, there are a variety of, if not lockdowns, certainly Jilin has been struggling on that front. There are certainly ongoing restrictions. And even take Beijing, for example. Beijing is not technically under a lockdown, but it's certainly under rolling restrictions. I mean, the citizens or the residents are being required to undergo mass testing on a frequent basis. So that level of disruption is being seen right across the country. They have had some success stories. Shenzhen went into a lockdown maybe a month or so, maybe 2 months ago at this stage, and they seemed to contain the virus. And of course, that gave optimism for supporters of COVID-0 in China that there is a way out that they can contain Omicron. But I think most people are saying, look, even if they do contain Omicron, this thing is going to continue spreading, and that's going to mean more restrictions and more disruptions and more downward pressure on the economy into the year end.
And awesome to catch up, buddy. As always, Enda Curran of Bloomberg. And Lisa, you said it earlier this morning. The very fact that this is the official data we're talking about, it's already dreadful. Tells you a lot about the situation we're in that economy.
Typically, the official data is massaged to make it look better, and that's why everybody has sort of shadow statistics to understand what the ramifications could be for Europe and perhaps the U.S. as well. And so, honestly, have we fully priced in what that means with respect to supply chains, further inflation, and just in general, trade?
Talked about this city note a few times this morning. Lost time is never found again. The impact of COVID lockdowns on economic activities proved larger than expected in April and looks set to extend into June or even beyond. That's the line from Citi, Tom. They've gone down to 4.2 from 5.1 for GDP growth this year. Does it get revised lower from there?
Well, it may get revised lower, but within that note is the idea of medicine to the rescue. That's what we did, John. We did it with mRNA. China's chosen not to do that. To me, it's much more a medical issue.
The worst is perhaps over, in the words of Citi, as the government looks to set up its support, or step up its support. Futures down about 1/3%. From New York City this morning, good morning to you all. This Monday morning, this is Bloomberg Surveillance.
Nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modificaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The fears we have today are tied to one thing, really, inflation.
How can the Fed or other central banks, for that matter, really think to get it under control in 12 months' time? I think that's incredibly implausible.
The challenge with inflation is that it's so misunderstood that the Fed may need to overshoot in terms of rates.
As long as inflation expectations remain anchored, I think the Fed is okay with overshooting their target.
Of course, the Fed is wary. It doesn't want to cause a market collapse.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on television, on radio, a Monday to a very busy week. Yes, retail sales tomorrow, but John, mostly it's a recalibration in equities, a recalibration in bonds.
Across the street and leading that effort is David Costin over at Goldman Sachs. He goes to 4,300 from 4,700, and that's not the first downgrade on the S&P so far this year. And in the near term, it's 4K on the S&P, which TK is basically where we are. And I keep going back to this point because it's so important. The Fed is telling you they want tighter financial conditions. The Fed is telling you that they do not want higher equity prices and tighter spreads. They do not want a weaker dollar. They want a further tightening of financial conditions. That is essentially what Mary Daly, the San Francisco Fed, said last week, Tom. And I think that is so important going through this summer.
The tightening of those conditions is bond price down. We're going to address that in a moment. John, Amanda Lineman with Goldman Sachs in the last hour, it was clear there is a bond bear market.
There is, Tom. There is. And in the Treasury market specifically, have we seen the highs? That's what I want to get into. 320 on a 10-year. Was that the high for this cycle? 292.58 right now. Bank of America does not think we've seen the high on the front end.
Yeah.
They do not think that story is over. They think later this year when the Fed has to reassess, they have to reassess the long dots higher, and your 2-year could get through 3% again.
The reassessment of this really globally, folks, is not only equities and bonds, but Lisa Abramowitz, it's about what politicians will do with it. The language on inflation, the language on the pain to the middle class and, yes, the elites. It's stunning what we've seen over the last 48 hours.
It's an election pitch, as this is the predominant issue, as people go to the grocery store and figure out what to do in aisle 7, as you pointed out, which tends to be the most expensive aisle. Look, we're looking at a market that still is showing signs of strength, at least in the United States. And this is the conundrum. When do we start pricing in a growth scare? We're already there a little bit. When does it come to fruition, given the fact that consumers still have cash and still are spending? At what point do the retail sales that we get tomorrow show us a very different picture?
But critically, and Critic Gupta, I thought, nailed this, Lisa, the idea of consumers are still spending. Which consumer is still spending?
That's a good question, right? The sort of bifurcation of the haves and the have-nots, and how much does the Fed pay attention to this? Have they basically lost that social conscience that seemed to be a driver of them earlier? Because inflation hits everybody, and frankly, it hits the lowest income individuals the hardest, and that has to be their focus right now for every reason.
John, what was the distinction in your reading over the weekend? I mean, it's almost like recalibration Monday here for me, going in, the mid-year outlooks, John, they all start here coming out. What was the distinction to what you saw?
Here come the downgrades. That's going to be the story for us at 9 o'clock on Bloomberg TV, Tom, as we count down to the opening bell. Downgrades from Goldman, Morgan Stanley, not downgrading the year ahead outlook, but in the near term say we could threaten 3,400 on the S&P. You've got a downgrade on growth from Goldman for the U.S. economy, a downgrade from Citi for the Chinese economy. Is that it? Have we fully discounted the risk in our future? Some people will be asking that question.
Here's my sophisticated data check to get it started, John. Brent crude rounded up 111, wheat up big, corn up, and rice is an unspoken story, John.
Yeah, it's pretty quiet in the Treasury market. Your 10-year 292 in the FX market, euro-dollar basically going nowhere. Euro-dollar 104.19, 104.20, up 0.1% on that currency pair. So a little bit quiet out there, Tom, in the FX market and in Treasury markets too.
Yeah, I'll go with that as well. I'm looking at rice right now. It's gone from 12 up to 17 here in 2 years. That's U.S. rice. That's, of course, a global story. Looking globally at debt is Anthony Rodriguez. Tony Rodriguez had a fixed income strategy at Nuveen. Thrilled he could join us today. Tony, you know the history of Nuveen. It is steeped in original products way back 30, 40, 50 years. And, of course, the advent of the company in 1898. You've never seen price down like this, have you?
No, good morning, Tom. Good to be with you. Most difficult start to a year that we've seen. We're seeing a massive rise in rates in the context of how low we had been, where we were pretty close to zero across the board. So you're seeing almost double-digit negative returns for the broad fixed income markets. And so what we think that is very much a significant re-rating on both the Fed and growth prospects. And so the Fed, we know now, is priced in pretty aggressively. So we don't see a whole lot more coming from that side, but we do think there's potentially some higher rates still in the medium to longer term end of the curve.
Tony, talk to me about where that's going to come from in the Treasury market and what's going to develop that story.
Yeah, so we think it's going to come primarily from the front end to intermediates. We're going to see a further flattening of the curve. When we look at the long end of the curve, the 10-year, our call has been that we'd end the year around 3%. We'll probably obviously see higher points than that over the course of the year. We've already seen a 3.20, but ultimately we think we end the year closer to 3. But the 2-year rises up to be basically a flat curve. So the idea is that further Fed tightening is going to come. Some modest upward pressure on rates will come with that. And then when you look at the risk markets, we think there is still some potential further widening coming, but that the majority of the widening that we've seen in credit markets is behind us.
Taking a step back, Tony, give us the scenario in which this comes to pass, because what you're talking about is something that speaks of perhaps a longer-term inflationary outlook that doesn't scream recession in the same kind of way that some other outlooks do. Is that correct? Is this basically saying that the Fed can tighten as much as they're planning and we still get some persistent inflation and, frankly, along with that, growth?
Yeah, I think the story is that we are going to see inflation that is above the Fed's target for the next 2 years, but we are going to also see inflation that is moderating from where we are. So peak inflation, in our view, is behind us. The question is, will there be, for example, further shocks to the system that mean inflation stays elevated at current levels for an extended period of time? So our view is that if inflation does moderate, the underlying strength of the economy in terms of the corporate balance sheet and the consumer is enough to possibly support a soft landing. Now, of course, the landing strip has gotten shorter and narrower, week by week, month by month. But right now, we still think, like if you look at what the Goldman forecast that's implicitly saying a soft landing, we still think that is something that could achieve. But clearly, the probabilities decline as you see weakness in China, as you see the Russia-Ukraine war continuing, as you see zero COVID in China impacting the global markets.
So, Tony, in this soup that we have right here of geopolitical developments, of a Fed that's tightening, of the post-pandemic reality, where's the haven?
Well, right now, we think that the haven is really in what we would call a diversified portfolio. So the haven's not going to come from any single asset class. But when we look at the fixed income markets, given the re-rating we've seen with rates higher by almost 200 basis points at the front end, with spreads wider in high yield by over 150 basis points, we do think that a diversified portfolio of fixed income spread assets and some credit, some treasuries, also to provide a little bit of cover in case we see another downside from either supply chain pressures or geopolitical risks. We think that portfolio, which today is yielding you a good 200+ basis points more than where we were at the start of the year, provides a reasonable risk reward for an investor. So you're earning close to mid-single digit returns in an environment that's still pretty uncertain, and an equity market that, while we're not bears on the equity market, is clearly still at best case fair value.
This has been a tough year. Tony, wonderful to catch up with you as always. Tony Rodriguez of Nuveen. Thinking of tough years, we talk a lot about tech. Let's talk about the banks. JP Morgan year to date down about 25%. Goldman down 20. Often go over these names just to remind everyone how many we've seen in the red, deep into the red so far this year. Morgan Stanley down 18, Citigroup down 21, Bank of America down 21. Mike Mayo of Wells saying this: JP Morgan must prove to investors that, quote, its superior standards for strategic and financial discipline, Tom, are still intact. It's been a tough year for Wall Street.
And to Mr. Mayo's point, I strongly agree with this, John. You are going to see a massive honing of business plans and tactical execution going into Labor Day to get ready for the end of the year and the compensation season next year. John, I really can't say enough about how fixed incomes got hammered and the way you do this, and we've never seen this. I've lived this, but this is much, much worse. You're down in bonds. You constitutionally can't buy JP Morgan equity. What do? You clip coupons, that's the old phrase, and you claw your way back. This emotion, John, in fixed income of clawing my way back is going to be the story for late summer.
Well, Tom, let's talk about that. How'd you claw your way back in the equity market? I think what we often forget is just basic maths. If you drop from 100 to 50 and you lose 50%, you've got to gain 100% to get back to break even. And Tom, that's where we are in a lot of funds, in a lot of names in this equity market.
You differentiate. I'm laughing, folks. This is a joke that John and I have. John, you differentiate between value and growth, and the answer is you grow your way out of a bear market. How do you do that in bonds?
Taking a lot of losses. And Lisa, to your point, and this is what people are talking about in fixed income, we've had the interest rate adjustment. We haven't really started to see the credit risk adjustment in a massive way just yet.
And if you do start to see that, do you see Treasury yields go the other way, right? Do they become a haven again as the growth scare percolates? We were getting Tony Rodriguez, perhaps not.
Up next on this program, a good friend of this show, Bill Lee, the chief economist at the Milken Institute. Looking forward to catching up with him. Futures down 1/3% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. It's another dramatic change in Europe's security structure triggered by Russia's invasion of Ukraine. NATO members rallied around Finland and Sweden after they announced plans to join the alliance. The one NATO member to voice concerns was Turkey. The country is unhappy that Sweden and Finland have had relations with Kurdish militants active in eastern Turkey. And China's economy is paying the price for the government's COVID-0 policy. Two key gauges of economic activity have fallen to the worst levels since the start of the pandemic. Industrial output unexpectedly fell 2.9% in April, whilst consumer spending shrank 11.1%. Carlyle Group has agreed to buy government IT contractor Mantech International. The all-cash deal is valued at about $4.2 billion. Mantech primarily works with U.S. defense and intelligence agencies. McDonald's is leaving Russia after more than 3 decades operating there. The fast food chain will sell its Russian business and take a write-off of up to $1.4 billion. McDonald's said that in the wake of the war in Ukraine, continued ownership of the business in Russia is just not consistent with the company's values. And JetBlue has begun a roughly $3.3 billion hostile takeover attempt of Spirit Airlines. It launched an all-cash tender offer and is urging Spirit shareholders to vote no on the airline's takeover by Frontier Airlines. The JetBlue offer is $30 a share, $3 less than its initial bid. JetBlue says it would pay the higher price if Spirit agrees to a, quote, consensual transaction. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Our big issue is how little tightening is priced for next year, 30, 40 basis points. That's a joke. You think about it, the biggest inflation worry in actual reality in the last 40 years, and how can the Fed or other central banks, for that matter, really think to get it under control in 12 months' time? I think that's incredibly implausible. So we expect a lot more tightening to be priced in for 23.
This is it. This is the story for so many people. There is consensus about 22. It's 23 where things start to break down. Mike Schumacher there, the global head of macro strategy at Wells Fargo, on what this Fed might need to do next year. Futures down about 1/3 on the NASDAQ 100, on the S&P 500 down 0.2% from New York this morning. Good morning. This is Bloomberg Surveillance with yields essentially unchanged on a 10-year, 292.58. Yields up by almost a basis point. Crude down by 1 full percentage point. Tom, just short of 110, 109.39 on WTI.
John, long ago and far away, with Bloomberg on the economy, one of my themes for the year was the growing of rice. Rice is a dominant crop, a huge part, say, of Cambodia's use of income, completely different in the United States. Aggregating all this after the shock of pandemic, the shock of a war in Ukraine, is Will Kennedy leading our coverage on energy and commodities, and he joins us this morning. Will, as a general statement, how much does rising energy prices fold into something as basic as rice or wheat?
It's a key component, I think, especially of wheat. Wheat relies on tractors and harvesters to plant, to fertilize, to harvest those crops. So it all adds up, along with fertilizers, something we've discussed several times, to a background of rising crop costs. And that's one of the factors that's feeding into higher prices right now.
What's some of the other causes right now? We're also looking at bad crops, right? That some of the weather hasn't been conducive to really yielding the amounts that people have wanted, including in India, which is one reason they've given for banning certain exports. How widespread is the weather component?
It's very important, and it's coming at a time where supplies are very tight for a number of reasons, principally the war, which has stopped almost all grain, wheat exports from Ukraine, one of the world's biggest suppliers, and the blockade of their Black Sea ports means that none of that's getting out, and that's created a tight global market. A country like India would not be particularly important in normal times to the global balance. It's a small, relatively small exporter, but right now the whole market is quite stressed. And as you say, weather is a big part of that. You've got drought conditions in India, which is making people pessimistic about the forecasts there. We've got difficult weather conditions in the US. Planting is a long way behind where it might normally be. It's too early to say what that will mean for the harvest this year, but it's worrying. So these weather conditions that we're seeing around the world come at a time of very tight global market, and that's why traders are jumpy.
Yeah.
Wheat was up by the limit today in Chicago. It's starting to test the highs we saw immediately after Russia's invasion of Ukraine.
So, Will, the reason why we're talking about this ahead of the open here in the U.S. is partly because this is a crisis unlike what a lot of people have been saying. You've been covering the commodity sector for more than 2 decades. What is the analog, the historical analog for the shortages, for the price hikes that we're seeing in basic staples for everyone, frankly, but also particularly in the developing world?
The obvious example is what we saw in 2011 when rising wheat prices led to food riots around the world, and specifically was seen as one of the key drivers of the Arab Spring. People are concerned that we're going to see something similar. I mean, events in places like Sri Lanka, which has a number of drivers, of course, but rising staple prices always add to political crises. Now, but going back to what Tom said at the beginning, one of the saving graces and one of the reasons why we're perhaps in a slightly better situation than 2011 is that rice prices, the staple for about half the world's population, have remained relatively subdued, not something we saw a decade or more ago in the last food crisis. So that's one slight cause for optimism.
But Will,
sorry, go ahead,
what do the experts say about the linkage of rice to wheat, or are they completely delinked?
They're not completely delinked, but there isn't as much substitution as you think. The rice-consuming parts of the world tend to be pretty discrete from the wheat-consuming parts of the world, and there will be a bit of substitution at the margin in places like Africa, but on the whole, wheat is the staple, the world's biggest staple, and as long as those prices remain subdued, I don't mean to sound overly optimistic, but it does mean that it's not as bad as a situation that we've seen in the past, perhaps.
Well, financial markets usually focus on oil and gas prices in the forefront. How much has that shifted in the people who you talk to the soft commodities, or is it still very much? And what's happening with Russia and some of the bans that even Germany is now implementing?
Yeah, I think the point is here, for many countries, what we're getting now is a run-up in both food and fuel prices at the same time, which is one of the key drivers of inflation here. If you think about the US will be affected by higher wheat prices. It will feed through the whole food supply chain, and that will come as consumers are already grappling with diesel and gasoline prices that are hitting records. That's the mixture that consumers in many parts of the world are facing. And of course, in places outside the US, in many developing countries, that comes at a time where dollar strength is making the cost of commodities imports high already. So it becomes quite a mixture for many, many countries.
Well, wonderful to get your perspective on things, as always. Will Kennedy there of Bloomberg on the situation with agricultural commodities, not just energy. And Lisa, the rise of protectionism is a real threat going forward from here. Regardless of India's contribution to exports in a particular good, that's a bad sign.
It's a bad sign when people start hoarding just basic food for their population because they are worried about those riots. They're worried about the price of goods. At what point do we enter a regime that we haven't really seen in modern history with respect to food supplies? Even Janet Yellen coming out this morning and talking about how this is probably one of the biggest crises to emerge from the Ukraine war.
This is the spillover, Tom, and it might just be the beginning.
Well, it's a spillover, but also it's got the history of Arab Spring. I mean, let's be honest, John. Food inflation had a huge thing to do with the upsetting of the Middle East. Our expert, Eric Martin of the International Monetary Fund, he is heated, John. He studies Egypt.
Tom, developed markets largely escaped that situation. Catching up with Mohammed on Friday, Mohammed Al-Erin, talking about the EM-type situation that DM faces this year on so many different fronts.
Yeah, well, I'm going to go with that, and I think the tone here on as we said, a reset Monday here into mid-year outlooks is how do you do a mid-year outlook on food other than, as Will Kennedy said, even rice up this morning.
That's about the only time horizon that I could probably process, Tom, a mid-year outlook to mid-year. At least for about 2 months.
I agree
Beyond that, through the summer, I've got no idea.
Can you even do 2 months, honestly?
I can get out 2 Fed meetings, maybe, just about.
All right, good to know. I don't know. This is uncertainty of a new caliber.
And Lisa, I've mentioned this a couple times this morning, but let me codify it. I think the financial media has grossly underplayed the decline in price in fixed income away from the typical things we quote. It's stunning, some of the numbers I'm looking at.
Driven by rates, it's been a bloodbath, but how do we move from that to actually go forward, and where do you find the value if you're clipping coupons?
Tom, we are the financial media.
It's okay, he's taking a dig at me.
Lisa covers this all the time.
I'm okay with it. The real yield. It's the best show on TV.
Come on.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Live from New York City for our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Futures unchanged on the S&P, on the Nasdaq 100, down about 0.1%. That is something that we wouldn't usually cover. That is a monster downside surprise on Empire Manufacturing. Mike McKees ran into the studio to break this one down for us. Hey, Mike.
Yeah, it is bad news, John, and it does show that we are still having problems in the economy. It's not exactly clear whether this is a supply chain problem or a fall off in demand, but the Empire number does drop 36 points to a negative 11. It is also, the New York Fed is saying that new orders dropped significantly and delivery times lengthened. So it does look like we have run into some problems. Negative 11.6. Remember, it was 24.6 last month.
Down about a basis point on a 10-year, 291. No big changes in the equity market, still down about 0.1%. Mike, if we get a series of numbers like this, what do you think this could mean, or maybe won't mean, for the Federal Reserve in the next few meetings?
Well, I don't think it's going to affect the Fed too much because they've already told us they're going to do 50 and they're going to wait. They have to wait and see what happens. But the real issue here is, are we seeing a decline in confidence, either because interest rates are going up, which they haven't gone up that much, but maybe based on forecasts, or because people see problems in the economy? And if you get a decline in confidence, you're going to get less investment. Now, this is kind of what the Fed wants, but it may be happening faster than we anticipate. The Empire number doesn't always correlate very well with the national ISM figures, but they were down a little bit as well when we came into this month.
That's what I was going to ask. I mean, these have been highly volatile numbers, and they've been swinging pretty violently. There was a pretty substantial growth last month. How much does this really give people a sense of what's going on versus yet being one more tea leaf, the first of the May tea leaves that we're going to get?
Well, I think you have to be very careful with the Empire number because it is sort of a tertiary number, and manufacturing in the New York State area not huge compared with some other parts of the country, but it does sometimes set the tone for the month. It's the most recent data that we have for manufacturing, and it will lead us into the Philly Fed, and then we get from other Fed banks around the country, like Dallas and Richmond, we get numbers, and then we get the national ISM. And again, it's going to be a question of whether this is a supply problem, whether it's China and the problems we have with getting stuff out of there in COVID-0, or whether it's demand. All of a sudden, people have decided they don't want to buy stuff anymore.
Mike, thank you, as always. Just ahead of this print, we got this note from Andrew Hollenhorst and Veronica Clark over at Citi, and they said the following: market concern is rising about downside risk to activity, meaning metrics like industrial production and retail sales, both out this week, take on some increased significance. However, they go on to say, Tom, data on wage and price inflation remains most important for asset prices. This is particularly the case given Chair Powell's strong indication last week that price stability is his key concern. So even if we get these downside surprises on economic activity, there is this belief in some parts of Wall Street the Fed keeps going because the focus is on something else.
It's all, will the jobs market break? And in the hotsiest message from Goldman Sachs, they did frame out unemployment rates that are elevated, but not anything that we would call a crisis. Right now, let's move on with this economic analysis of the United States to a more global sense. Off of the Milken Institute meetings, William Lee joins us, their chief economist. Bill Lee, can the markets constrain or restrict the Fed? If we look at the Bloomberg Financial Conditions Index, it's sort of doing its job right now, making financial conditions more restrictive. How will the Fed react to that?
Well, right now, the markets are doing 110% of the Fed's job because the market increases are way above where, as John just said, actual increases, but also the expectations of that aggressive policy stance is something that the markets have clearly priced in. And I think it's based on some misguided information. My colleague, former colleague Andrew, is an example of that, where he's focused on the aggregate wage price numbers. And I've been looking at the micro wage price numbers, and I really don't see massive signs of a wage price spiral as 1970 style. In fact, most of the wage increases have been going to where the labor shortages are appearing, the low wage workers, the younger tenured workers.
Billy, you're world famous for this, and it goes into a decile analysis, I would guess. Economists like Citigroup love to aggregate numbers together. What part of that decile analysis matters for Chairman Powell in the view forward?
Well, Chairman Powell absolutely cares about the aggregate number, but do you see aggregate wage price spiral? Now, granted, the Fed has lost credibility since its meetings. The average inflation rate break-evens that are priced into 5-year securities is way above 3.5%. But given that, I think we shouldn't get too carried away with how much the Fed has to tighten. Don't forget, the Fed, for the first time in Fed history, we have two policy tools, the balance sheet and rates. And I think one of the strategies that they haven't talked about enough is using that balance sheet to cool off and target those red-hot sectors in real estate and consumer durables by draining the liquidity from there, especially the mortgage backs, and by then easing up on the amount of rate increases they'll need. This is, again, the first time in history of the Fed with two policy instruments, it may be able to escape crashing the economy to bring inflation down to its target level.
Bill, some of that in the market ended in a bit of a mess in 2018 when they tried to wind down the balance sheet. They're doing this at a much more aggressive level, twice the speed, once they get going. Bill, can you just add a little bit more colour to that? How much they're about to do with the balance sheet and how this is going to work through the economy, through financial conditions?
This is one of the great uncharted territory because the Fed has really never done balance sheet before. And as you said, the last time it did it in a very clumsy way. Right now, it has to be very careful in using that mortgage-backed securities holdings because that is where the real red-hot sector is, the real estate market. And draining liquidity there is going to be absolutely critical. But now the Treasury runoff is something that will be done on almost autopilot because it has maturity holdings that are so short. But I think the key to the Fed's policy stance is how aggressive does it have to be with rates on top of that. If you really believe that there's a wage price spiral being priced in, then it has to be aggressive, no doubt. But my view of the numbers on the labor market is such that, if you're above the median wage or median profile of the median worker, you're not getting the 10, 12% wage increases. You're getting barely 2 and 3% for the senior managers. So I think the Fed has to cool off a bit in terms of worrying so much about that wage price spiral. There really is no sign of it yet taking hold. And I think that's something that Wall Street has missed entirely.
Even so, if the Fed is targeting inflation, even if it's not coming from the wage price spiral, there are so many inflationary pressures coming from China, from the supply chain disruptions, which are not necessarily positive for growth, which are not necessarily signs of momentum, but still the Fed has shown a willingness to target demand in order to respond to supply side responses. What's your view on how far they would have to go to normalize the supply and demand side of the equations?
Well, that's the lesson learned from the 70s. You cannot let prices get out of control. Even though a lot of the inflation is coming from the supply side, the Fed's job is to equilibrate supply and demand. If you can't get supply up, then you certainly have to bring demand down. And the wrong way to do it, though, is through targeting investment, which is the cost of capital. Right now, I think the key to inflation in the future is productivity-enhancing investment. That has to be encouraged. And I think the Fed to choke that off just for the sake of hitting its 2% target in a reasonable amount of time would be a serious mistake because that would cost us in the 3 to 5 year horizon in boosting inflation without those productivity-enhancing investments.
Right now, we've got a 2-year Treasury yield at about 2.5%. The team over at Bank of America, which we'll catch up with John in a little bit here, believe that it will go up to 3.5%. Do you think that would be enough to torpedo this economy, to actually send the United States into recession?
It would be enough if we drain liquidity adequately from the red-hot sectors using the balance sheet. It will not be enough by traditional measures. And so I think that this, as I said, has got to be a time when the Fed can no longer say the balance sheet is the passive tool and the secondary tool. It has to become the primary tool for cooling the economy. And as far as China's concerned, by the way, the real key to watch is whether or not China becomes aggressive and takes over more aggressive about Taiwan. Because the lesson learned from Ukraine that shocked the leaders over there is that the world came together and became much more cohesive. That will put a stopper, I think, on military incursions into Taiwan, but it won't stop their cyber attacks or political strategies. So there, the supply constraint is a real issue because TSMC is global. There is no substitute for advanced chips. We can find other places to buy wheat. We can find other places to grow corn, but we cannot find another TSMC.
But just quickly, within the Communist Party, do you think that the leader, President Xi, is in a position where he can make a step as bold as the one that you just described?
Right now, if he gets his third term, the one thing on Xi's mind is that he will leave the legacy that he created the path of returning Taiwan to China. This is something no one has accomplished. Deng Xiaoping, no one, not even Zhou Enlai or Mao Zedong. And so this has been a China obsession for decades, ever since China opened. So you betcha he's going to be going after Taiwan. The question is how. And right now, the world coming together about Ukraine, I think, has put a stopper on any overt military actions.
Bill, wonderful to hear from you, sir. As always, Bill Leather of the Milken Institute. Tom, with a different perspective, and for some people, a worrying perspective on future developments.
Well, and this is Bill Lee of the Pacific Rim and, of course, his work of IMF. I would say this is an undercurrent, John, where, yes, there's this huge focus on Ukraine. We understand that. But I would suggest there's an undercurrent of new analysis on Taiwan and then down to the South China Sea, particularly after the Philippine election. That's maybe something to talk about in the fall.
Coming up in the next hour, we'll catch up with Mark Cabana, the head of US rate strategy at Bank of America Global Research. As Lisa pointed out, a really punchy forecast for the front end of the curve from them. 350 on a 2-year. And essentially, Lisa, forecasting yield curve inversion all over again. 350 on 2s, 320 something, 325 on 10s.
Yeah, this has been basically the idea that people have. How far does the Fed have to go to become restrictive? And then does that mean, if we do get yield curve inversion, recession again?
Empire Manufacturing,
yeah,
absolutely dreadful. Big downside surprise. Yeah. Futures unchanged on the S&P, unchanged on the NASDAQ, Tom.
Is Newcastle United dreadful?
They're not that dreadful anymore. They're better at this point of the season than they were about 6 months ago. You need them to win, Tom.
Yeah.
Or at least get some kind of a result.
It's in the middle of the surveillance nap, but we'll figure that out.
You're going to wake up and watch that, are you? Okay.
Got it.
From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. Twitter is now on course to wipe out all the gains the stock has made since Elon Musk disclosed his stake in the company. Shares are lower in pre-market trade. On Friday, Musk tweeted that the deal is on hold, but that he's still committed to buying. After a trip to Kyiv, Senate Republican leader Mitch McConnell says he expects the Senate to pass a $40 billion aid package for Ukraine on Wednesday. McConnell and several other Republican senators met with Ukraine's President Volodymyr Zelensky on Saturday. Last week, Republican Rand Paul held up the aid bill, arguing that it's too expensive. Germany plans to quit importing Russian oil by the end of the year. That's even if the European Union fails to agree on a ban in its next set of sanctions. German officials are confident they can solve logistical problems in the next few months. Russia's share of German oil consumption has declined to 12% from about 35% before the war in Ukraine. And it is the latest move by a Wall Street bank to retain talent in a hot job market. Goldman Sachs will allow senior staff to take an unlimited number of vacation days. That's according to a company memo seen by Bloomberg. Junior employees at Goldman still have limits on vacation, but they'll be given at least 2 extra days off per year. The U.S. Justice Department is investigating a mass killing in Buffalo as an act of racially motivated violent extremism. The shooting left 10 people dead and 3 wounded. 11 of the people shot were black. An 18-year-old white man was arrested. Law enforcement officials say he posted a hate-filled document online not long before the attack. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
In the beginning of the war, the perception was that NATO is strong and NATO can act, that NATO can deliver. And the only thing EU can do is to express different levels of concern in public statements. And the war proved that everything is completely different. It's NATO that, as alliance, as an institution, can do very little, if anything.
Mr. Kuleba of Ukraine, and speaking with our Maria Tadeo this morning, an important conversation. Of course, the news that we're seeing in Finland and Sweden just is stunning this morning on the war in Ukraine. Lisa Bramwitz and Tom Keene with you on radio, on television, and now to get out front of a sacred oath. Mark Esper, you know him as a Secretary of Defense of modest controversy for President Trump, but far more the most coveted award at West Point. There is a statue at West Point, and far more the heritage is seen in the Thayer Hotel of one Douglas MacArthur. And when you win the Leadership Award at West Point in honor of General MacArthur, it's a big deal. One of those winners, Mark Esper, joins us. Winner maybe doesn't do it justice. Mark, tell me about what General MacArthur would do today with all of his controversy within the Republican Party, the middle 20th century, isolationism and that. What would General MacArthur do with this modern Defense Department that we have?
Well, it's a great question, and I guess thank you up front for the introduction, Tom. You know, MacArthur, we would consider him today to be a combatant commander, right, because of his command in the Pacific and later during the Korean War. But you know, for West Point, West Pointers and others in the military were most recall his famous saying about duty, honor, and country. And that is the West Point motto. And he says, those three hallowed words reverently dictate what you ought to be, what you can be, and what you will be. And it was that phrase and that saying, as it goes, is what in some ways guided me during my tenure, both as Secretary of the Army and Secretary of Defense.
I am fascinated by your thoughts of and this is a very sophisticated word, sir. I don't know if you saw this at West Point, the ginormous NATO exercises going on right now from Estonia and Lithuania on down. This is a new world we are in. Is our Defense Department ready with Secretary Austin for this new world?
We are getting ready. I think a hallmark of the Trump administration was we advanced a national defense strategy that I made #1, my top priority to implement. But this defense strategy also described a new era of great power competition, defined as China as our top strategic adversary, and secondly, as Russia. And to confront these two countries, particularly China, we really need to modernize the military, from the equipment to our training to our doctrine, and all those things are underway. So it's important that the Pentagon continue on with what we developed during my tenure, and that we also provide the funding. That's really, you can't do it without having funding. And I've been disappointed by the White House's, the Biden administration's funding requests these first two times. They've been flat, and thankfully the Congress increased the spending. And that's going to be critical to driving change and modernizing the armed forces.
Secretary Esper, based on what we've seen with Russia's invasion of Ukraine, how should the U.S. military view what to expect with Xi Jinping and Taiwan, especially as he does seek yet another term?
Yeah, look, it's the great question. Russia, we always define as a superpower, but a declining power. And it's been evident from their actions the last 90 days in Ukraine that they're not quite the power that we thought they were in terms of military capability. 10 times bigger than Russia. Economic interdependencies that run around the world. We're seeing, just because of the shutdowns due to COVID in Shanghai and other places, how the supply lines reach. So we need to be very careful about how we plan and prepare to deal with China. We need to send the same and the proper signals of resolve and determination to defend young democracies, or democracies like Taiwan, and make sure they understand that we're going to defend this world order, these sets of norms and values that have really helped promote prosperity and freedom around the world for the last 75 years.
Secretary Esper, the Trump administration was known for looking inward, to being very nationalistic in the approach to geopolitical concerns. And we're at a moment where NATO seems to be coalescing in order to deal with Russia and the invasion in Ukraine. How much should the U.S. military and beyond sort of build on this coalescing of NATO and work with allies in order to get some sort of bigger presence, whether it's in Asia, or at least to figure out how to respond if there is an invasion of Taiwan?
Yeah, look, we absolutely have to. I consider myself a Reagan Republican. Ronald Reagan promoted American strength, peace through strength. He believed in the defense of democracies and the world order as we understand it, and believed that we should stand up for our friends and allies. And I made an important plank of my tenure to really go out there and try and strengthen our allies and grow new partners. And I'm a big believer in NATO, and having served in NATO as a young Army infantry officer, I believe that we need to continue to do this. And I'm glad to see finally that NATO is coming together. More countries are willing to commit more for defense, and that we have possibly, hopefully, two new countries joining. And, you know, ironically, it's Vladimir Putin who brought the alliance together. So the key thing will be sustaining this momentum as we, at some point, look eastward toward China.
Mark Esper, the nation was fractured off of Vietnam. Republicans fractured, Democrats fractured. It was equal opportunity. But we're still adjusting, and now, as Robert Gates would say, from our holiday from history, we're still adjusting to the debris of Vietnam. Are we adjusting in real time? And how do Republicans and Democrats come together to help those with a sacred oath?
You know, you're right. I mean, after the Vietnam War, it took the Army 12, 15 years when I entered active duty in 1986 to really rebuild under, again, President Reagan. And I think now we're coming off the wars the last 20 years in Iraq and Afghanistan. And again, during our time, 2018 and beyond, we began rebuilding the Army and all the services. So it will take time and money. But look, I've said on many occasions here the last couple months or so that the greatest threat I see facing our country is the extreme partisanship on both sides of the aisle that is creating dysfunction in Washington, D.C. And then, until we solve that problem, it's going to be hard to take on the big issues such as, you know, our growing budget debt. It's what, $30 trillion? How do we come up with a consensus that with regard to a strategy toward China? How do we address all these big issues facing our country? And that's going to be key going forward.
going forward is what we wanted to accomplish here. Mark Esper with an important book. For those of you on radio, you just need to know there's a certain weight to it, like 600 plus pages. Mark Esper, A Sacred Oath, really can't say enough. And of course, he leads front and center with a gentleman that he worked for at the White House. Lisa, what an odd Monday. It was really a recalibration Monday.
Especially after all of the notes over the weekend, with everybody saying that there could be potentially a significant amount of downside. The uniting feature of a lot of these notes is if we're pricing in simply the Fed tightening, perhaps we're there. If we're not, if we're pricing in a recession, there is more to go, and that was the view of Lori Calvasina and a bunch of other strategists. How much is that going to become the consensus, Tom?
Stay with us on Bloomberg Radio and Bloomberg Television through the morning as we recalibrate. Lots of people publishing this morning. John just mentioning the Citigroup note that came out maybe 20 minutes ago as well. I would state, for those looking for optimism, the VIX under 30, 29.07. gives modest comfort. Stay with us. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
A lot's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Here we go again, live from New York City this morning. Good morning, with your S&P 500 down just a couple of tenths of 1%. The countdown to the open starts right now.
everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue. Here come the downgrades.
We're seeing a lot of headwinds. Well, these really huge headwinds.
Notably lower growth, and we're going to see frustratingly high inflation.
A very challenging growth inflation mix.
Stagflation, unfortunately, is the baseline.
Stagflation is toxic for traditional assets.
Is it a soft landing? Is it a recession? Is it stagflation?
It started out as an inflation scare.
Wall Street's biggest concern is inflation.
Then it became a growth scare as well.
There's a lot of conflicting signals.
Whether we get something worse depends on the soft landing debate for the Fed.
The Fed is effectively trying to thread a needle wearing oven mitts blindfolded.
It's a very small needle to thread.
It may end up hiking too much and pushing us into recession.
There's just generally so many headwinds.
Joining us now to discuss flow banks, SD Dweck, Bank of America's Mark Urbana. SD, first to you. Have we seen the worst of this yet?
Oof, I'm hoping, but we probably haven't. There's still a lot of concerns. We got some disappointing data from China today. We don't know the impacts yet from the Shanghai lockdowns and if that's going to impact inflation and sort of force the Fed to hike more than they want or than they would in other circumstances. And we just see that there's a lack of buyers in this market. There's still a lot of fear, and so we probably have a little bit more to go on the downside.
Mark, you don't think we have in the bond market either. I'm looking at your two-year call. 2-year right now, 258. Are you guys at 350? Mark Urbana, can you run me through that, how we go from here to there?
Sure, yes, we are. We think that this inflation backdrop that we're seeing today is likely going to warrant an ongoing tightening from the Fed beyond what the market is currently pricing. Our base case, our economist forecast, is for Fed funds to reach 3.5 to 3.25% by May of next year. But we do see risks that it could potentially be higher or that the timing could be faster than we currently anticipate. And this is really due to the fact that inflation is too elevated and the real policy path, the real policy rate, is too low. We think that the Fed needs to tighten financial conditions more in order to get that inflation slowdown. And unfortunately, that's probably going to mean more turbulence for markets ahead.
Mark, what's your inflation forecast going through the rest of the year? What pushes the Fed to make this call?
We've got core PCE at 4.1% by the end of the year, in line with the Fed. And then by the end of next year, that's 2.5%. So it's moderating, but it never goes back to where the Fed's 2% target is, at least over the next 18 months or so. And as a result, we think that the Fed is going to be frustrated by sticky high inflation, a labor market that is still very strong, and it's probably going to have to do more tightening than the market currently anticipates.
SD, what would that mean for you? 350 on a US 2-year.
That would mean a lot more pain because if the Fed continues to hike and doesn't at some point, let's say around Jackson Hole in August, start to acknowledge that it has to keep an eye on growth, the expectations that they will manage that all-elusive soft landing are going to vanish completely. And then I don't think we're pricing in a full recession. We're certainly pricing in a growth scare. We're starting to price in something of a hard landing, but we're not pricing in a recession in the U.S. at the moment. And that means more downside for the equity markets as well, in addition to a lot more pain in the bond side. So I'm hoping then that the Fed sees the gradual descent of inflation, this disinflation, even if it's slow, that we're going in the right direction, and that at some point they acknowledge that they have to keep an eye on growth and they have to keep an eye on the labor market.
So David Costner Goldman put out his work over the weekend, going into the weekend. That was one of the downgrades we've talked about throughout this morning. On the S&P 500, they've come down from 4,700 to 4,300. They think the gains are going to be at the back end of this year. They say we assume as the year progresses that investors will gain confidence about decelerating inflation, the path of the Fed, all of the above, recession risk, and equities will rise modestly. It's their 3-month call that gets my attention. SD, they said our 3-month forecast is 4K. The reason being, is that equity markets going higher would ease financial conditions, and that is not what this Fed wants. And it kind of echoes what Mary Daly of the San Francisco Fed said last week. They want tighter financial conditions. Actually, in many ways, are they just giving the game away for the rest of this summer? This Fed wants equities lower and credit spreads wider.
I mean, those are two of the biggest components in your financial condition index. So you have to assume that I don't think they want equity markets lower, and they shouldn't underestimate the wealth impact in the U.S. and how the U.S. consumer is going to feel very quickly compared to the poorly, I'd say, compared to the last 2 years. But they certainly don't think they've tightened enough yet. I think they still are thinking about front loading. So we get 2 more 50 basis point hikes. That has probably a further impact on equities and on credit spreads because they're going to keep that rhetoric quite hawkish in the short term. And again, later in the summer, hopefully, then they start to acknowledge that they've done quite a bit. When you think about re-anchoring those long-term inflation expectations, your 10-year tips are still at 2.6 something. They're not outrageous. It's just the next 12 months. And it's having that patience to watch inflation come down very slowly. And those next 2 months, I think, are going to stay quite painful for the markets and with their rhetoric.
And Mark, this is what I hear a lot. Este's gone through it, kind of echoes what David Kostin over at Goldman's saying as well. You get to the back end of the year, things start to improve, maybe the Fed backs off. Your call and the essence of your call is that they don't, they can't, and they won't. Do you get that pushback in your client conversations too, Mark? And what do you say back to them?
Yes, so we are hearing that pushback a bit more, but it's consistent. You know, our view is consistent with the notion that the U.S. labor market has been very tight, is slated to tighten further. The economy has a lot of momentum, and that the Fed is going to have to put policy into place such that financial conditions tighten and such that overall consumption slows. That's the only way that the Fed can get inflation under control. And a lot of the pushback that we get is, well, what about the equity put? What about how tight financial conditions need to go? What can the Fed do about this? And our view is that, look, right now, when the Fed looks at the strength of the economy versus the inflation outlook, they have an inflation problem. They need to keep going, and they need to credibly ensure that inflation falls. We're still seeing inflation surprise to the high side for now. And so that just means that the Fed is going to have to remain in a relatively hawkish place and keep going. And if they don't see that inflation begins to moderate, and again, we saw a pretty big beat on core CPI last week. Yeah. Yes, it was influenced by airfares, but it was still more elevated inflation. If they don't see that inflation starts to fall in line with their forecasts and with the street's forecasts, then they're going to have to keep policy in a tight position. And the trade-off must then be that they're going to accept a little bit slower growth in order for lower inflation.
Mark, it seems to me that our relationship with financial conditions and how that relates to the Fed is very much stuck in the previous cycle. We keep seeing these moves in the market as problematic for this Fed. That's how we used to look at it. Are you saying it's a feature, not a bug?
This is how they impact the real economy. And if the Fed is going to slow inflation, it is going to be through financial conditions. Now, let's not forget the fact that financial conditions have eased a tremendous amount over the last few years. The Fed erred on the side of providing too much accommodation, arguably for too long, but they did that in light of the very sharp economic slowdown that we saw right after the pandemic. And so now what the Fed has to do is get the economy back into a better equilibrium. They've got to take some of the air out of financial conditions. That's exactly the direction that they're moving in. And right now, policy is still extraordinarily easy. The real policy rate is still deeply negative. And this is something that the Fed is going to have to fix if they do want the economy to reach a better equilibrium and for inflation to moderate and get close to their 2% objective.
22 minutes away from the open and bound futures, negative about 0.2% on the S&P 500. Katie Lyons, we have had a ton of downgrades over the weekend.
Yeah, strategists have to play catch up, right, John? Because this year has just gone a lot worse than pretty much everyone anticipated. Back in January, the average strategist thought the S&P would rise about 5% this year to around the 5,000 level. We're now down 16% year to date, trading around 4,000. And you also didn't see people getting it right in the bond market either. The consensus at the start of the year was that the 10-year yield would hit 2% by June. Instead, it hit that in early February and touched as high as 3.2% earlier this month. So strategists having to wrap rapidly adjust to this market. Actually, almost half the equity strategists tracked by Bloomberg have lowered their year-end targets. Goldman, as you were mentioning, is among them. Plus, analysts that focus on specific names are also slashing their price targets at the fastest pace since the pandemic crash of 2020. What we're looking at here is the number of daily price target cuts. You actually saw one day last week where there were 130 cuts on a single day. The average over the past 20 sessions has been about 80. And of course, part of the reason for that is the deteriorating growth outlook. Slower growth, of course, could start to weigh on earnings. And on the growth side, the downgrades are hitting there as well from Goldman as well over the weekend, cutting its outlook for both this year and next. The view for 2022 lowered to 2.4% from 2.6%. And out in 2023, John, slashed from 2.2% down to 1.6%.
Katie Lyons, thank you, as always. I always enjoy the Mike Wilson note from Morgan Stanley. Comes out on a Sunday just to start, or end your weekend to start the week. And he says something bearish and then it ends it with, enjoy your Sunday. Let me see if you enjoyed your Sunday once you read this. On the S&P, this is what Mike Wilson thinks can happen here. We remain confident the lower prices are still ahead. In the S&P 500 terms, we think that level is close to 3,400, which is where both valuation and technical support lie. Before he wrote that, he wrote this. With valuations now more attractive, equity markets so oversold and rates potentially stabilizing below 3%, stocks appear to have begun another material bear market rally. Essie, can I come to you on that? Would you call what we're seeing play out at least a couple of days ago a bit of a squeeze, a bear market rally, but ultimately we haven't seen the lows yet?
You know, we're flirting with that 20% mark, whether it's a bear market rally or not. I agree that for now they're going to be relatively short term and that there is further pain. The technical picture, I also have to agree that is still pointing to further downside and further pain. So at the moment, it does feel like these rallies are going to be violent, but probably short, and that a lot of people are going to want to fade them until we feel that we've had something of a more solid bottom at some point, probably and hopefully in June, that can come and give confidence for investors to come back in. But at the moment, for the next month or so, it doesn't feel very attractive. It doesn't look very attractive. And if what we were saying earlier about the number of rate hikes to come, then we're going to have even more concerns about growth and possibly another re-rating of valuations for equities.
Esty, do you have any confidence that in Mark's world, things have stabilized in the Treasury market?
You know, it was interesting to see that your Treasury yields are coming down while your equity markets are coming down, so that positive correlation appears to have at least paused, if not broken for now. It's also interesting to see the VIX come down a little bit, despite what we saw in the markets last week. So at some point, we are starting to see incremental better news and some positive signs for the markets. We're hearing that Shanghai should be reopening relatively quickly over the next couple of weeks. We are seeing that inflation is pointing downward, maybe not fast enough, but at least in the right direction. So we're starting to get those positive signals. But I think if the Fed sticks with this hawkish rhetoric for a very long time, you're going to have that growth picture start to worry investors, and that could weigh on markets a little further.
Right on cue, we're getting some Fed speak. It's from the New York Fed President Williams. He says the following: we need to get real rates back to zero in the next year or so. Mark, that is your view. It's the real rate view, not nominal rates, real rates. They think we need to get back to zero. Then he expects inflation to decline quite a bit next year. Mark, talk to me about that. Just really hit home that story, that message that you've got with the team at B of A, that it's not about nominal rates, it's about real rates and where you think that needs to be.
Yeah, Jonathan, this is a great point. This is exactly what we've recently been arguing, and it's actually what we use to justify our forecast revision somewhat higher. It's the fact that when the Fed has recently talked about the neutral rate, they've been talking about the nominal neutral rate, right? Powell says, well, we want to hike until we get to neutral, which is 2 to 3%, he says. But when he talks like that, we hear him talking about the nominal rate, i.e. the one that includes inflation. And we know how high inflation is today. And as a result of that, the nominal neutral rate is not a particularly relevant concept. What matters if the Fed wants to get a handle on inflation is where the real policy rate ultimately ends up. And we completely agree with New York Fed President John Williams. We were writing about how we thought Fed rhetoric was going to shift in this direction to focus more on the real policy rate. And as a result of that, the Fed has to keep hiking rates quite quickly, at least in the near term. Now, we don't know exactly when they want to get the real policy rate positive. If it's by the end of the year, then the Fed ultimately needs to get the policy rate above 4%. We think that's probably a bit extreme. The Fed's likely looking forward on where inflation is headed. But even if they agree that inflation is going to be around 2.5% by the end of next year, then the Fed funds target rate has to be above that, and probably quite a bit above that, in order to try and slow the economy. So we continue to expect a lot more discussion and focus from the Fed on not just the nominal neutral policy rate, but the real rate, which is what's going to matter for the economy, and that's what's really going to slow financial conditions. Seems like the Fed is indeed moving in the direction that we've recently been thinking and writing about.
Mark Cabana sticking with us alongside Esti Dweck. Want to get you some moves ahead of the opening bow with futures just a little bit softer. Here's Abby.
John, beneath that relatively flat surface, we do have some outsized movers, starting off with the shares of Spirit Airlines soaring. This on a hostile takeover bid from JetBlue for $30 in cash, better than Frontier's roughly $19 cash and stock bid. But you can see the stock trading still closer to the Frontier bid. More drama to come, perhaps. Carvana also up sharply as the used car retailer soaring on a strong earnings outlook. Plus, they are cutting costs to the downside, though. Last Friday, of course, was all about that big tech rally. We have NVIDIA, one of the top performers last Friday, up about 9.5%, the best day at that point since March. Now down, giving some of that back. And Twitter, John, heading to its 7th down day in a row, of course, losing about 20% over the last 6 days as Elon Musk's bid is on hold. Can Twitter make it an update? Right now, not so much.
Seeing that in the 30s with an agreed price of 54.20. There's a spread. Abby, thank you. Coming up, China's economy paying the price for the nation's COVID-0 policy.
We see the shock out of China documented by the numbers overnight. And there's a pretty awesome decline in industrial production that we saw, a super awesome decline in consumer spending.
That conversation, up next.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Zero tolerance for COVID is here to stay. That's the policy of the land. They're going to tough it out. So I don't see any sign of them breaking right now. We see the shock out of China documented by the numbers overnight. And there's a pretty awesome decline in industrial production that we saw, a super awesome decline in consumer spending. We're looking at a contraction for the second quarter almost certainly.
Some pretty dire forecasts for that economy. The economy in China buckling under the country's stringent COVID-0 policy. Industrial output, consumer spending, all plunging to the worst levels since the beginning of the pandemic. This as auto sales came to a halt. Here's a stat for you. Not a single car sold in Shanghai last month, with 25 million residents under lockdown. Mike McKee has more for you. Morning, Mike.
Morning, John. You got to love the way Carl put it. A super awesome decline in retail sales. They were down 11.1% on a year-over-year basis in the month of April, and we saw a decline in industrial production of 2.9%. Everybody focused on Shanghai and Shenzhen being shut down, but a lot of other important cities in China were shut down too. And you can see that the results we got out of that, and the one thing I hadn't mentioned is the yellow line there is unemployment rising. We're back to where they were at the height of the pandemic. So it is causing a lot of damage to the Chinese economy, which means it's going to cause a lot of damage to the global economy. Shanghai, they say, is starting to open up, but won't get back to whatever normal is until sometime in mid-June or after. Citi and Morgan Stanley cutting their GDP forecast, and as you heard Carl say, a lot of people expecting this second quarter to go negative, including Bloomberg. You look at what's happening with global supply chains. We saw that in the Empire results here in the United States, plunge into negative territory for the month of May. So where does it leave us? Kind of worried. The Chinese have not been cutting their main interest rate. They've cut the reserve ratio. But as you can see, we don't have a lot of credit demand in China. So it doesn't really matter at this point. They're not getting much bang for the monetary policy buck. And is there really more stuff they can build? And that's why you see in the Bloomberg monthly index there, it's starting to go below zero in terms of total growth. It's not going to be good news for China or for the world.
Some of these numbers are brutal. Mike, thank you. Esty Dweck and Mark Urbana with a final word. Esty, how tough is it, how uncomfortable is it to get long Europe with numbers like that out of China and the situation evolving as it is in Ukraine?
I think it's very difficult, definitely, to be overweight Europe. When you look at the numbers out of China, when you consider the size of the import and export market that China represents for Europe, these lockdowns are going to continue. They aren't going to help with the inflation picture. Although, again, we're getting a little better news in Shanghai. You couple that with the refugees, the food prices, the energy prices for Europe that are still so dependent on gas and not just Russian oil. And the picture is really looking recessionary, at least in pockets, and potentially much more than that. And I think European equities have actually been resilient considering this backdrop, but I wouldn't expect them to outperform.
Mark, this gives you the final word. We've got a slowdown in China, slowdown in Europe. A lot of people arguing for recession, tighter financial conditions, and the Fed's hardly got moving just yet. You think they're going to have to do a whole lot more work. If people say to you, well, Mark, look at how sensitive things already are, and we've hardly gotten started. QT doesn't even begin until next month. Why do they have to go a whole lot further, given everything we're already seeing play out?
Certainly, there's downside risks to the global economic backdrop, and the Fed will be taking that into consideration, as they already have. But the truth is that domestically, inflation is still far too high for them to accept. Monetary policy is still far too easy for them to accept, and they actually have to get policy in an outright tight position if they want to have any hope of seeing inflation fall. Now, the real question for the Fed is, can they get this balance right? Slowing the economy in order to bring inflation down while there are global headwinds to growth. Are they going to be able to engineer the soft landing, or are they going to overdo it as they've typically done?
Yeah.
We see risks that they end up overdoing it. We see risks that they end up tightening a bit too far in the face of an economic slowdown that probably inverts the curve. And it may indeed stop them out of tightening if they see a recession that's clear in the U.S. But in the near term, the economy remains strong. The Fed has to keep tightening in this type of environment, and they need to see clear signs of domestic slowdown, which we don't see quite yet.
Starting to see it just a little bit. I know your view, though, Mark. We're going to see a whole lot more. Mark Urbana, Esty Dweck, your morning calls up next.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Stocks down, here are your morning calls. JP Morgan upgrading Cigna to overweight, highlighting a favourable valuation. Wedbush upgrading Netflix to outperform, highlighting management's move to address saturation. And finally, DB cutting its Ralph Lauren price target, pointing to a weak setup ahead of earnings. Up next on the programme, Peter Cheer of Academy with futures negative, the open next.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
24 seconds away from the opening bow this morning. Good morning. 6 straight weeks of losses on the S&P. We equal the tally back to 2011. And a lot of you hoping we don't make it 7. Equity futures on the S&P down about 0.4%. On the Nasdaq, we're down 0.5%. On the Russell, down by a third. There's your opening bow. Switch on the board and get to the bond market. Yields look a little something like this, coming in a couple of basis points to 289.31. 6 weeks of losses on the equity market. We had 5 weeks of gains in 10-year Treasury yields, and then last week, yields lower. Lower again today by a couple of basis points. The euro, just a little bit stronger. Euro dollar, 104.23. Crude down 1/3%, 110.18. About 20 seconds into the open with your movers. Here's Abby.
John, let's hone in on some of the weakness that we are seeing for stocks here on the open. And of course, that has to do with big tech. The chips in particular, last Friday, both AMD and NVIDIA up more than 9%, the best day in quite some time on that tech rally. Today, giving some of that back. I know that Taylor Riggs will be looking at some of the other names, including Twitter. To the upside, we do have Occidental Petroleum and some of the other energy names, the best sector on the day right now. Occidental Petroleum up 1.4%. In the pre-market, AMC, it had been trying for a third up day, the animal spirits part of last Friday's rally. Not so much right now. Let's see how the day plays out.
Abby, thank you. About a minute into this, energy top of the pile at 0.4% on energy stocks. On information technology, down at 1% on the S&P. We're down 0.4% in the early part of the session. Big tech has been a big problem. Taylor Reese has more. Hey, Taylor.
And John, the numbers you just pointed out, frankly, has been the theme for the year, right? Energy's been the big performer, and technology, again, just sort of at the bottom of the pile, and that continues a little bit today. We did a decent bounce on Friday, but remember, we're climbing our way out of a pretty big hole, and again, now in the opening market, out of pre-market, rolling over again, once again, when we think about some of the big tech companies. We talk about market cap here. The massive drawdown that we've had on the NASDAQ 100, you're now down in the hole of something like 26% from the latest drawdown of some of the latest peaks that we've had, some of the big record highs that we've had. 26% drawdown. That is a pretty big pull down that we've had. You've wiped out about $3.7 trillion as well of market cap during that time. Of course, Twitter isn't necessarily big tech, but it's something that we talk a lot about on this program. So a little bit of the smaller big tech here. We'll just point out Twitter. Again, nowhere near sort of that 54.20 price target. A lot of price targets, John, given the buyout, it was at 54.20, but a lot of the analysts that we speak to on the program, frankly, say like, that's overpaying, that it just isn't worth that much. So you see there, of course, around a 38 handler.
So if you go to the ANR function on the Bloomberg, and Taylor, you know this already, for other subscribers out there, you can find out what the previous price targets were before they all went to 54.20. I'm thinking of Goldman at 30. Goldman were at 30 before this deal came about, and right now, Taylor, 38. We're in the 30s.
Yeah, you know, and John, look, didn't Musk say that he was putting it on hold while he investigates some of the bots? I think a lot of the analysts struggled with. Everyone has sort of pointed out, it was in the 70s a year ago, right? But as we know, the last price target is no indication on what a future value of a company is worth, particularly as we continue to re-rate all of these companies. So I am not hearing a lot that it's worth anywhere near 54.20, at least from some of the analysts that we speak
I'm
with.
sure Facebook would like to live in 2021 again as well. Netflix would like to live in 2021 too. Life doesn't work that way. Let's not get too deep and philosophical. Taylor, thank you. Looking forward to your coverage a little bit later. Way too early for that. I think it's always, it's never appropriate when we're talking about finance to get philosophical and deep about anything. Taylor, thank you. Twitter, 38. 54.20 the agreed price, and what a spread. It's ridiculous, isn't it? 38. I still don't know what putting a deal on hold actually means, but we can get to that later. A lot of retail sales earnings coming later in the week. Retail sales tomorrow on deck. Let's get to Kelly for more. Hey, Kelly.
Yeah, John, let's start with what we are expecting out of that retail sales data for the month of April. Overall, on the headline figure, expected to rise by 1%. But when you back out autos and gas, it's actually only expected to be a 0.7% increase. Really, what we're going to be looking for here is clues as to just how much higher prices have crimped discretionary spending and whether demand destruction has started to kick in. And that is going to be critical for the retailers reporting this week as we get their results. Just how much pricing power have they been able to exercise and the ability to pass on higher input costs that they are facing? Our analysts here at Bloomberg Intelligence, just looking at Walmart, for example, say gross margin actually could contract due to those elevated costs. We'll get those figures as well as Home Depot tomorrow, Target, Lowe's, TJX on Wednesday, Kohl's on Thursday, and several more to round out next week, all of which could bring insight into just how much consumers are willing to pay up for things that they want versus things that they need. It's really the difference between staples and discretionary that is front and center here. And from a stock performance perspective, we have seen staples outperforming discretionary by a margin of 20 percentage points so far this quarter. That is the widest margin going all the way back to 2001. Staples, the second best performer in the S&P quarter to date on a sector basis. Discretionary at the very bottom of the pack, down 19% over the period so far. And it'll be interesting to see if earnings reinforce that sour sentiment, John.
Kelly Knights, thank you. Awesome work, as always. This in my inbox this morning from Peter Cheer of Academy Securities I think is so important as we think about this market over the last couple of years compared to this market, say, 10 years ago. These are the words of Pete. Most of the time, Wall Street tends to focus on big institutional flows. You're used to hearing that. For years, that was probably okay. Pete goes on to say, but that led to horrible decisions during the pandemic. Retail flows were a crucial driver of markets, and we are, what Pete says, we are at an inflection point where retail will be a big determinant of what happens next. I'm pleased to say that Pete joins us now. Pete, I was looking forward to catching up with you once I read this note. I'm always looking forward to catching up with you anyway. You said traditional versus disruptive portfolio construction. Let's start there at 35,000 feet and work our way down. Pete, what are you trying to get at?
So if we go back, traditional portfolio construction, you would be, here's some really risky assets, here's my core holdings, tends to be stocks, and then you've got safety, which is treasuries, money markets, bank accounts. And I think what we really saw during the pandemic was what we're calling disruptive investors. And they came in and they want altcoins, NFTs as their risky part of their portfolio. They consider, disruptive tech, ARKK stocks, Bitcoin as their core portfolio. And I think they actually considered big tech as their safe haven, their equivalent of bank accounts. And so I think what we're seeing now is a big unwind of that. And you're seeing some phenomenal wealth destruction, right? There was phenomenal wealth created, it's being destroyed. And I think we're at this inflection point where people are going to either say, hey, I can double down, or I think much more likely, hey, we have to have some safety. I have to protect this wealth that I originally had that I've given so much up.
So Pete, work me one way through it with you then. So talk to me about how that dictates how we perform on the way down and how we recover as we bounce.
So I think more downside to big tech. I think we're really watching the Apples, the Microsofts of the world. Do you start seeing selling in that as people actually really move to true safety? So, money markets, bank accounts, and this is across the board, right? We all of a sudden have much better yields than we did. The 10-year yield is now well above where the S&P dividend yield is. So I think you're going to see this shift where people say, I'm going to take slightly less risk for what looks like similar returns. And if crypto cracks it all, and I think Bitcoin really has that possibility given what went on last week, I think you see an accelerated sell-off in crypto, the disruptive stocks, and that drags everything else down with it.
Pete, I used to hate this term, the smart money versus the dumb money. What it used to mean was people really staring down their nose at the institutional versus, say, the retail being the dumb money and the institutional money being the smart money. And the point you're making here, Pete, is what has led us has actually been the retail flows. You're not the only one to make that point over the last couple of years. Jim Bianco of Bianco Research has been on top of that story too. So help me understand what our leading indicators should be and where we should look for them, where you would look to for them.
So I am looking at Bitcoin. I think if that cracks, it drags everything else down. And then I am looking at the Apples, the Microsofts of the world to see if there is that kind of selling pressure. They've started to roll over a little bit. And if I'm correct in these kind of disruptive investors who are holding those types of stocks as their equivalent of cash, and they're getting nervous, there's more downside there. And because those are such big components of the indices, it drags the S&P down and kind of takes the entire market down another, I think, 5 to 10% pretty easily.
Pete, how receptive are clients when you have this conversation with them and trying to explain why it's different this time compared to how it was in the last 10 years?
I think right now everyone's reasonably receptive because I think it's been such a difficult market to follow. So we're all looking for what makes sense. What can you say is a theory that actually looks like it's played out? And I think this one is resonating with people. They're seeing it in the flows. They're seeing it in their thought process. I think everyone wants to buy this dip. And that's the other thing. We keep talking capitulation, capitulation, capitulation. And yet, if you look at some of the riskiest assets, so TQQQ, which is a triple levered NASDAQ 100 ETF, it is at almost its biggest size ever, right? It's had nothing but inflows. So I do not think we've seen this retail capitulation. And that's what I think we're on the cusp of. And Bitcoin going down below, I think, 25,000 probably triggers that to me.
Pete, in terms of these two cohorts, are the catalysts for their investment decisions different? Do they respond to different things? The institutional investor, the retail flows?
Yeah, I think the institutional investor right now, if you're a large hedge fund, you're trying to stay close to home because it has been so volatile, it's so liquid. I think on the asset manager side, everyone's, again, trying to stay close to home to their indices. They don't want to be caught out. What I do think is if we get this final sell-off, people will be capitulated into it, and that will be the real buying opportunity. And the sell-off, though, will be led by retail. I think, investors on the institutional side are much more balanced right now than they've been in a long time.
So let's put a bow on it, Pete. It sounds like you want to buy, but ultimately you don't think we've seen the lows yet.
That is correct. And I'm much more comfortable being overweight credit right now. I like credit where it is. I just think we have one more leg down in stocks. Having said that, I've been a big fan of energy companies. I continue to like that. I think we are going to see a lot of spending to revitalize our energy industry, and they're going to be huge beneficiaries.
What's the credit versus equity story for you, Pete? Just walk me through that.
So I think it's much more a valuation story, right? I don't think we're headed to a deep recession. We might get a small recession based on what's going on in Europe, but there's been such a big buffer, and credit is so well protected. Plus, with yields so much higher, again, I think you are going to see people move from risky equities into, say, dividend-paying equities. You're going to see people move from dividend-paying equities into corporate bonds into treasuries. So that's that rotation, which is going to be very supportive, I think, from going forward on yields and corporate debt.
Pete, do the retail flows ever come back in the way that they were built up, say, back end of 2020? Remember the short-dated call option volume we were seeing in some of these big tech names, single-name stories? All that upside, and it just begets more selling, and then buying begets more buying. Pete, is that ever going to come back?
I don't think so. I think we're going to need to see VIX really come down so that weekly option game can, come back. I think Wall Street has gotten much more smart. They realize kind of this gamma squeeze game, so I think they hold the offers higher, and we're making retail chase, and that's over now. And I think you're seeing that. It's even across the board, right? You look at the gambling stocks; they're all way down. Participation, what we call kind of this gambling nation, is really dropping off. There was a lot of excess liquidity. There was a lot of excess cash. People are getting free money, and they took that free money and kind of were very free and careless with it. That's now changed.
With that in mind, Pete, then, you've walked me through how the retail flows will dictate the bottom. It doesn't sound like you think they're going to dictate the recovery.
No, I think that's going to be institutional flows. I think it's going to be hedge funds realizing, okay, the worst is behind us. There's been a lot of pressure, I think, particularly from the CTAs who've been leading on the market. So I think they keep trying to push futures down. So when we eventually get that rally, I think it'll be a very fast, vicious rally. People will look to pile into money. People will look to outpace their indexes. And I think the hedge funds have a lot of capacity to get net long here. So I think the final rally is really going to come from institutional investors, but we've got to watch retail, I think, for that leg down.
So, Pete, this is important just in terms of the recovery then. Some parts of this market, I assume from what you're saying, will just be left for dead, because that institutional money won't be in it in the same way retail flows were.
I think it's going to go back to being, a 2 to 5% of your allocation, where you can say, okay, I want some really, really risky assets that, might be, 5 times, 10 times within a couple of years. But this concept of I want 30, 40% of my portfolio in something because it could double in 2 weeks, that's over.
Peter Chair of Academy. Pete, great to catch up. Interesting perspective, something we've not given enough thought to, I think. At least for me. I'm not going to speak for everyone. We're down about 0.2 on the S&P, about 12 minutes, 13 minutes into the session. Your Nasdaq's down by around about a third, but we have been all over the place. Coming up, NATO running around Finland and Sweden after announcing plans to join the alliance.
There is very strong consensus for bringing Finland and Sweden into the alliance if they choose to formally apply.
That conversation up next.
It's almost the end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
There is very strong consensus for bringing Finland and Sweden into the alliance if they choose to formally apply. And as to the differences between Turkey, Finland, and Sweden that have been talked about, there's an ongoing conversation. And the bottom line is this: when it comes to the membership process, I am very confident that we will reach consensus.
NATO preparing to add Finland and Sweden into the alliance. This as Germany looks to halt Russian oil imports by the end of the year, with or without an EU agreement. The foreign minister saying the following: we still have to clarify a few things. That won't happen here today, but I'm very confident that we'll come to a conclusion in the coming days. Joining us now is Bloomberg's Anne-Marie, who tells us she is not on vacation. She's in Abu Dhabi. And Maria Tadeo in Brussels. AMH, I'll leave that for another time. Maria, just to you, the latest, please.
Yeah, well, Jonathan, we now hear from Sweden, also a confirmation from the Socialist Party in the country that leads the government. They say that they will apply for this NATO membership. Remember, there is a very important summit at the end of June. The idea is that both Finland and Sweden will make this formal step by then. And by the end of the summer, they will be full-on members of NATO. That's on the military front. When you look at still the perennial conversation in Europe, which is energy, once again, we hear from the Germans now say we're ready to pull on this oil embargo. But here's the thing, Jonathan, you have to look at the numbers. The number of oil barrels that are going from the Russian Federation into Germany have declined from 35% before the war to now 12. So this is not a big deal for them at this point. What is a big deal is gas, and that continues to be a no-go. Also, when you look at the no-go, the Hungarians still say that they would veto any energy embargo or any energy measures that would lead their economy into a recession. So no consensus for the time being. This is now 2 weeks delayed.
Anne-Marie, on a serious note, what's the relationship between where you are and what's taking place in Europe, in Ukraine, and the situation with Russia?
Well, it's very interesting for the United Arab Emirates, Jonathan, because this has really been a safe haven for Russian money. Even if you look at the real estate market, a record start to a year. And a lot of that is because it's attracting Russian wealth. So this has been a place where oligarchs or elites in Russia can come and be safe and park their cash. At the same time, we have the United States asking the likes of the UAE, asking Saudi Arabia to pump more oil. Now, they're in this also interesting relationship because it took them in years. And I was there for many of these years as they tried to cajole the Russians to join in on this OPEC plus group. And at the moment, they don't think that the market needs that oil. So it's a very interesting time, one, for this U.S. delegation to be here because of this war that is raging, because you haven't heard the Emiratis really condone what's going on.
The US would call Abu Dhabi, where you are, the UAE, a partner. I'm trying to work out how you define that partnership, Anne-Marie, at the moment.
It's a great question because it's been a tricky one over the course of the last year. And I think it comes down to energy and security. So from the Emiratis' perspective, as well as the kingdom's perspective, it has been tricky in terms of the Iranian-backed Houthis having strikes on both of these countries. And at the same time as Washington having talks with Iran and Washington having this urgency to potentially re-enter Iranian nuclear agreement. This is something that many GCC countries, all GCC countries, do not want to see. And then at the same time, you have Washington calling these capitals, asking to pump more oil, and they're not doing it. But what you have today is really a massive show of force. I mean, Jonathan, if you look at the list of individuals, the VP, and we just got a pool report that she had entered, and she'll be speaking with Mohammed bin Zayed, the now leader of the UAE. She is alongside the Secretary of Defense, the CIA's Bill Burns, climate envoy, John Kerry, who I traveled here with, Secretary Blinken. This is a massive show of force. And Norman Rowell, who used to work for the CIA, spoke to him earlier, and he said, if you look at the delegation, that can tell you what the signal the U.S. is trying to send.
Where do the Saudis fit in here, Anne-Marie?
Well, the Saudis have yet to get a visit as high level as this, right? This is the vice president flanked by a lot of members of the president's cabinet. At the moment, there's a lot of negotiations behind closed doors, high level individuals that are going back and forth from Washington to Riyadh. And they're working on a number of fronts: investments, oil, and of course, defense and security, because Riyadh, like Abu Dhabi, doesn't want Washington re-entering an Iranian nuclear agreement. When it comes to the Saudis, though, what is going to be interesting, of course, is the president had campaigned on making this a pariah state due to Mohammed bin Salman, the CIA report about the killing of Jamal Khashoggi. And now you do see the administration making a shift. We had a recent call between the president and King Salman of Saudi Arabia. It's going to be interesting, though, potentially, Jonathan, what happens with the Crown Prince, Mohammed bin Salman, because at some point the administration will likely have to engage with him.
Maria, just on the energy front in Europe, what's the signal we should take away from the EU-level decisions that we have become accustomed to, from the Germans saying, okay, it sounds like we're going to have to go it alone?
Yeah, Jonathan, I think what they're trying to do is put an ultimatum on the table using something that is not going to have a shock impact on the German economy. If this was a conversation about gas, it would be entirely different. The fact that it's oil and they can manage to do that, I think they're trying to pressure everyone else to get on board. When the Germans in Europe, they send a political signal, usually that injects a lot of momentum in the conversation. So this is a move that in many ways is designed to get the Hungarians and Viktor Orban on board. For the time being, however, there is no shift whatsoever from Viktor Orban. He still says, as long as this damages my economy, I can't sign on to it.
Maria, I promise you a final word on the Eurovision contest over the weekend and your great disappointment that Spain just didn't make it. What happened?
No, actually, I feel like the fact that Ukraine won this, the country's been through so much that really they deserve this. I think it was a moment of almost, catharsis for a lot of people, but Spain did great. She looks amazing. She sings, she dances. She's like beautiful. She's going to be a huge star. And, I don't get paid to say this, so this is really what I believe in my heart.
I know, you messaged me over the weekend. You said you must watch The Lady and the Dancers from Spain, and I haven't made it yet.
This is quite diplomatic of Maria, I have to say.
Highly diplomatic, AMH, who is not on vacation in Abu Dhabi. Maria, today I was in Brussels. Maria, thank you to both of you, as always. From New York, equities lower, about 7/10 on the S&P. We're down 9/10 now on the NASDAQ. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
"26 minutes into the session, all over the place once again. Nothing new here. We're down 0.5% on the S&P, on the Nasdaq down 0.8%. That's the price action. Here's the trading diary. President Biden meeting with the Greek Prime Minister at 3:30 Eastern. U.S. retail sales out tomorrow morning, plus earnings from Walmart and Home Depot, and a host of Fed speak through the week. Bullard, Harker, Kashkari, Mester, Evans, Powell, all on the agenda. Finally, another round of initial jobless claims coming up on Thursday morning. From New York, new trading week, same story. Equities lower on the Nasdaq by about 1%. From New York, this was the countdown to the open. Thank you for choosing Bloomberg. This is Bloomberg TV.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon.